and demand trading. If you're a trader looking to understand how the market works at a deeper level, this is the perfect place to start. Miller introduces the powerful concept of supply and demand trading, which is essential for anyone who wants to make informed, calculated decisions in the market. Miller explains how supply and demand dynamics drive price movements and how recognizing these imbalances between buyers and sellers can give you an edge. The main goal of this book is to help you identify high-probability trading zones, those critical areas on the chart where market imbalances create great opportunities. So, if you're ready to learn how to spot those key trading zones and understand market movements like never before, make sure to stick around. And if you're new here, don't forget to like, share, and subscribe for more trading tips, strategies, and detailed breakdowns. Let's jump into the exciting world of supply and demand trading. Chapter 1: Traditional Support and Resistance. Let's begin where most traders start their journey, the age-old concepts of support and resistance. Frank Miller opens this chapter by taking us back to the fundamentals. If you've ever looked at a price chart and seen prices bouncing off certain levels, you've witnessed support and resistance in action. These are the horizontal lines we draw to mark where the price tends to stop falling, support or rising, resistance. But here's the truth Miller lays bare. Most traders stop here. They use these lines almost mechanically, expecting the market to behave like a bouncing ball. But the market, as we know all too well, is anything but mechanical. Miller paints a picture we've all seen. A trader marks support at a previous low. The price reaches that level again, and boom, it breaks right through. Stop loss hits. Frustration builds. The trader questions their strategy. Sound familiar? What Miller does masterfully in this chapter is not dismiss the value of support and resistance, but expose their limitations. He doesn't say they're useless. Far from it. Instead, he shows how relying solely on them can give traders a false sense of confidence. You see, these levels are derived from past price reactions. But here's the emotional twist. Price doesn't move just because it touched a level in the past. It moves because of the invisible forces behind the candles, the supply and demand of the market participants. Think of it this way. Just because you've been to a restaurant twice doesn't mean it will be open the third time. Something might have changed. The same goes for price levels. The strength behind a support or resistance level is only as good as the active participation of buyers and sellers at that level. Miller shares how many traders are caught in a trap. They expect price to reverse at horizontal lines without asking, why should it reverse here? Who's buying? Who's selling? And if you've traded long enough, you know the market loves to play tricks. It often blows past these lines, triggers stop losses, and then reverses. Painful, right? That's where Miller starts nudging us towards something deeper. He doesn't reveal it fully yet, but he hints that the real power lies in understanding where the imbalance between buying and selling is strongest. And those imbalances? They're not always where the traditional support and resistance lines lie. Let's pause and digest that. Support and resistance are popular because they're simple. They're visual. They make us feel in control. But Miller warns that simplicity without depth leads to misinterpretation. He's seen traders lose over and over again because they rely on static levels instead of dynamic forces. He even points out a common mistake: traders drawing too many levels, cluttering their charts, and confusing themselves. In Miller's words, a chart with more lines than logic is a disaster waiting to happen. He encourages discipline, not in just marking lines, but in understanding why a level matters. Now here's a turning point, the idea of zone-based thinking. While support and resistance are fixed lines, the market doesn't operate in lines, it operates in zones. These zones are regions where buyers or sellers took control. Not just one candle, not just one touch, but repeated aggressive action. Miller has successfully planted a seed in the trader's mind, a sense that perhaps what we've been relying on isn't the full picture. That support and resistance are a start, but not the destination. They're the map, but not the territory. And emotionally, this hits home. How many times have we felt betrayed by a level we trusted? How often have we wondered why price ignored our beautiful chart markings? Miller gives a comforting truth here. It's not our fault. It's just that we're looking at the surface, while the real answers lie deeper in understanding the true forces of supply and demand. Chapter 2, Introduction to Supply and Demand. Imagine standing at the edge of a market chart, not as a trader, but as a detective. You're not chasing indicators or following flashing signals. You're hunting something deeper, something raw, something real. Welcome to the world of supply and demand, the invisible hands that truly move the markets. Frank Miller peels back the curtain to show us the real reason why price moves. And it has nothing to do with luck or guesswork. It's all about one core principle, an imbalance between supply and demand. At first glance, it sounds basic, too simple, maybe. But as Miller walks us through this concept, we realize how everything in trading boils down to this single truth. When there are more buyers than sellers, price rises. When sellers outweigh buyers, price falls. That's it. That's the heartbeat of every market move you've ever seen. But here's where Miller goes deeper. He explains that price doesn't move just anywhere. It moves with intention, with energy, with force. And that force? It comes from large institutions, big money, those who truly create imbalances in the market. Retail traders don't move the markets. Banks, funds, and smart money do. And they do it by creating zones where supply exceeds demand or vice versa. So what does this mean for us? It means our job isn't to predict the future, it's to spot where the imbalance is likely to happen again. Miller gives us a practical image to hold on to. Think of the market like a battlefield. On one side are the buyers, on the other, the sellers. They clash at certain price levels, and sometimes one side overwhelms the other. That's where the magic happens. That's where trading opportunities are born. This leads to the first major insight of the chapter. Price zones are more important than price points. Forget those single-line support and resistance levels. What really matters are areas where strong buying or selling has occurred in the past, zones where institutions made their moves. Those zones, Miller tells us, are likely to be revisited. Why? Because large players don't complete their orders in one go. They leave footprints, and we, as smart traders, can follow those footprints. Miller introduces a subtle but powerful shift in mindset. Most retail traders are reactive. They chase price, follow indicators, or wait for confirmation. But supply and demand trading is proactive. It's about anticipating where the imbalance lies. And that's empowering. There's also an emotional reality here. Many traders, Miller notes, get stuck in noise, too many indicators, too much clutter. They overcomplicate. But this chapter is a breath of fresh air. It brings us back to the roots of economics, the first thing we learn in school. When demand goes up and supply stays the same, price rises. When supply goes up and demand doesn't, price drops. Trading isn't magic. It's a reflection of this basic principle. But here's the deeper layer. Not all zones are created equal. Miller explains that some supply or demand zones are weak. They barely caused a price move. Others are powerful. They pushed price hard and fast. Those are the zones we care about, because if price returns to them, it may bounce again. He also brings in the idea of freshness. A fresh zone is untouched. Price hasn't come back to it yet. That's important because once a zone is tested, the orders that created the imbalance may be gone. A used zone is like an emptied tank. It won't push price with the same force again. Miller makes it clear. This isn't just a concept, it's a framework for trading. It's how you read the chart, not just by watching price, but by understanding what the price is telling you about the power struggle beneath it. By learning to spot true supply and demand zones, you begin to shift from being a follower to becoming a strategist. You stop reacting and start preparing. You're no longer chasing trades. You're waiting in the shadows, ready to strike when the imbalance tips the scale. Chapter 3, Spotting the Golden Zone. In Spotting the Golden Zone, Frank Miller pulls us into the heart of supply and demand trading by revealing the single most powerful concept in his system: the golden zone. So what is the golden zone? Simply put, it's a price area, not a single point, where a strong imbalance between buyers and sellers occurred, causing a swift and meaningful price movement. It's where the market tipped decisively in one direction. And this decisive move wasn't random. It was triggered by large institutional orders that flooded the market. But here's the emotional hook. When price returns to this zone later, those leftover institutional orders often still remain. And that means you get a second chance to trade that imbalance. Miller calls this zone golden, not because it's rare or mythical, but because of its value. It's where you find the highest probability trades, the cleanest setups, the lowest risk, and the greatest reward. It's the sweet spot of professional trading. To truly appreciate the golden zone, Miller urges us to stop thinking like retail traders. He invites us into the mindset of big money. Institutions don't randomly click buy or sell. They position themselves at key levels where they can quietly build or unload positions without disturbing the market too much. But sometimes the imbalance is so intense that it causes a sharp move away from a zone. That's the footprint we want to follow. Let's dive deeper into the characteristics of a golden zone. 1. A sharp move away. Miller emphasizes this over and over. If price drifts slowly from a zone, it's weak. But if price rockets away, leaving a vacuum behind, that's a sign of a strong imbalance. That's your golden zone. 2. Freshness. If the zone hasn't been revisited yet, it's more powerful. The orders that caused the move may still be waiting there, ready to be triggered again. 3. Clear origin. The zone must be easy to identify. You should be able to see exactly where the move started. This precision helps you mark the zone accurately on your chart. 4. Structure before the move. If price consolidates or bases before launching out of the zone, that's an even stronger signal. It suggests smart money was accumulating or distributing quietly before making their move. Now, how do you actually spot a golden zone on your chart? Miller teaches a simple visual technique. Start by identifying a strong move, either bullish or bearish. Then, trace that move back to where it started. The last candles before the explosion? That's your origin. Mark the high and low of that base as your zone. That's it. It's like finding the ignition point of a rocket launch. You're not interested in the trail of smoke. You want to know where the fire started. Miller helps traders feel confident in waiting. In a world that screams, "Trade now," the golden zone strategy teaches patience. You wait for price to return to a meaningful area. You don't chase, you prepare. And when price does return, you're not jumping in blindly. You've already identified the zone. You've already marked it. You're just watching the price action carefully as it enters the zone, looking for confirmation, like a rejection wick, a tight range, or a volume spike. Miller also touches on why most traders fail to see these zones. It's not because they lack tools. It's because they're distracted by noise, indicators, patterns, conflicting advice. The golden zone cuts through the clutter. It gives you clarity. Trading is about probability, not certainty. But if you can consistently find areas where institutional footprints remain and price reacts to those zones with precision, you've tipped the odds in your favor. Golden zone is not just a technique. It's a shift in mindset. You stop trading randomness. You start trading logic. You stop chasing price. You start anticipating opportunity. And that, for many traders, is the moment where everything changes. Chapter 4. How to Draw Supply-Demand Zones, the Art of Precision Mapping. Miller opens the chapter with a clear message. Drawing zones is a skill, and like all skills, it must be practiced with care and consistency. It's not just about marking any area where price moved fast. It's about recognizing true imbalances on the chart and capturing them with surgical precision. So let's dive into his step-by-step method to identify and draw high-quality zones. Step 1. Find the strong move. The first step is to spot a price movement that was fast and clean. According to Miller, the most reliable zones are created when price explodes away from a level, either up or down, without hesitation. This kind of movement reflects a sudden, overwhelming imbalance between buyers and sellers. But not all fast moves qualify. Miller warns against being fooled by volatility spikes or news-based whipsaws. Instead, look for structured, impulsive moves that are backed by order flow, not chaos. Ask yourself, did price shoot up or down in a way that looked decisive and intentional? If yes, you found the foundation of your zone. Step 2. Trace back to the origin. Next, Miller explains the importance of identifying the base of the move, the launch pad, where the supply or demand imbalance began. This is typically a small consolidation area, a pause, or a series of candles that formed before the sharp move happened. This is where the smart money was likely placing their orders. The trick is to find the last candle or group of candles before the breakout. For a supply zone, where selling pressure took over, trace the move back to the last bullish candle before the price dropped. For a demand zone, where buying pressure dominated, go back to the last bearish candle before the price surged upward. That specific candle or group of candles is your zone origin. Mark the zone properly. Now comes the crucial part, drawing the zone with accuracy. For demand zones, mark from the low of the lowest wick in the base to the high of the last bearish candle before the price pushed up. For supply zones, mark from the high of the highest wick in the base to the low of the last bullish candle before the drop. These boundaries form your zone rectangle on the chart. Miller insists that less is more here. Don't make the zone too wide, or you'll dilute your entry accuracy. Don't make it too narrow either, or you risk missing the bounce. Precision is key. He emphasizes the importance of using wicks, not just candle bodies. Why? Because wicks often show where orders were triggered, and price briefly tested those areas before reversing. These are important clues left behind by big players. Step 4. Validate the zone. After drawing the zone, your next task is to validate it. Not every zone is worth trading. Miller suggests checking for a few key factors. Strength of the move away. Did price leave the zone aggressively, without chopping or hesitation? Time spent in the zone. Shorter is better. A zone that held price for just a few candles before an explosive move is more powerful. Has price returned to this zone before? If not, it's considered fresh and more likely to react. Location. Is the zone in alignment with higher time frame trends or major structure? Context matters. This step ensures you're not just drawing boxes, but identifying meaningful levels where institutional orders are likely to reside. Emotional discipline and consistency. Miller doesn't shy away from addressing the psychological side either. Drawing zones requires discipline and consistency. Many traders overdraw or second-guess their zones. But Miller advises to trust your process, stick to the rules, and refine through practice, not emotion. There's also a warning. Don't chase price. If you missed an entry because your zone wasn't perfect, let it go. The market always offers more opportunities. Forced entry just to be in the trade often leads to regret. Chapter 5. Always stick to the best. The discipline of trading only high-quality zones. Frank Miller issues a firm but friendly challenge to all traders. Stop settling for average zones. If you want consistent success in supply and demand trading, you must learn to stick only to the best quality zones, no matter how tempting it is to chase lesser setups. This isn't just a rule, it's a mindset. Miller starts by addressing a common trap, the fear of missing out. Many traders, especially those just starting out, feel a constant urge to be in the market. They mark weak zones just to have something to trade. But here's the truth Miller hammers in. Low-quality zones lead to low-quality results. And in trading, those results cost you money. Instead of trading every minor imbalance, Miller urges us to develop the skill and the discipline to say no, to wait, to let the market come to you with a zone that checks all the right boxes. So what actually makes a zone the best? Miller gives us a set of clear, actionable criteria to evaluate the strength and reliability of a supply or demand zone. 1. Strength of the move away. The faster and more powerful the move away from the zone, the better. If price launches out of a zone with large candles and little to no overlap, it signals a violent imbalance. That's what you want. Miller calls this the zone's footprint. A strong footprint shows that big players stepped in. A weak one, small candles, wicks, hesitation, suggests indecision. Avoid those. Ask yourself, did price leave the zone like it was shot out of a cannon? If yes, this is a candidate for a high-quality zone. 2. Time spent in the zone. Here's an interesting insight. The best zones form quickly. Price doesn't linger when institutions are active. Big money moves in stealth. They build positions fast and then let price fly. So if price spent just a few candles forming the zone before exploding out, that's a strong sign. But if price hung around, consolidated for too long, or showed lots of wicks, that zone may be contaminated or less reliable. Shorter time, stronger intent. 3. Freshness of the zone. Miller emphasizes trading fresh zones only. Once a zone has been touched or tested, the institutional orders sitting there may already be filled. That reduces the chance of another strong reaction. Fresh zones, those that haven't been visited since the initial move, have the highest probability of working. They're untouched battlegrounds, with unfilled orders still waiting. Bottom line, if the zone has already reacted, it's no longer the best. 4. Location and context. This is where experience kicks in. A strong zone isn't just strong on its own, it must also make sense within the bigger picture. Is the zone aligned with the higher time frame trend? Is it near a key turning point in the market structure? Does it sit above or below a recent range, suggesting a breakout trap? Miller urges traders to zoom out before trusting any zone. The best setups align across multiple timeframes. A demand zone on the 15-minute chart means little if the 4-hour trend is crashing downward. Context matters. 5. Clear structure and clean candles. Clarity is everything. The best zones are easy to spot. They don't require overthinking. A good zone should have a tight base, the consolidation before the move, clean candles without excessive wicks, a smooth departure from the base, no chop. If you have to convince yourself it's a good zone, it probably isn't. Why most traders settle for less. Miller gets real about the emotional side of this. Most traders don't stick to the best zones because they're impatient. They feel pressure to always be in a trade, but this mindset leads to poor decisions. He compares it to choosing between fast food and a gourmet meal. The fast food is quick and easy, but often regretful. The gourmet dish takes time, care, and preparation, but it's worth the wait. Trading is the same. How to build the discipline. Miller offers practical tips to stay disciplined. Create a checklist based on the 5 criteria. Don't trade a zone unless it ticks at least 4. Journal your trades. Track which zones worked and which didn't. Patterns will emerge. Trust the data, not your emotions. When you stick to only high-quality zones, your win rate improves, even if you take fewer trades. And here's the powerful mindset shift. Quality beats quantity. One A-plus trade is worth more than 5 mediocre ones. Patience isn't passive, it's strategic. Chapter 6, Tradable or Not, the Power of a Scoring System. Imagine this. You're staring at your screen. A supply zone looks decent. Not great, not terrible. Your gut says maybe. But your mind? It's torn. Should you take the trade or pass? The problem: emotions in trade selection. Miller starts with the hard truth. Most traders rely too heavily on feeling. They see a zone, hesitate, then take the trade anyway, only to regret it when it doesn't work. The root cause? No filter, no system, no scoring. So instead of asking, do I feel like this zone looks good? Miller wants you to ask, how does this zone score on the checklist? This flips your mindset from emotional to mechanical, from reactive to strategic. The scoring system, 0 to 10 points of precision. Miller introduces a 10-point scoring system that evaluates supply and demand zones across multiple dimensions. The goal is clear: only trade zones that score 7 or above. Let's walk through each scoring factor. 1. Strength of the move away, 2 points. This is non-negotiable. If price launched out of the zone with strong, large-bodied candles, little to no overlap, and minimal wicks, give it 2 points. If the move was decent but not explosive, give it 1. If price crawled away from the zone, give it it's not tradable. Tot 2. Time spent in the zone, 2 points. The best zones form quickly, usually within 6 candles. That suggests strong intent from institutions. Short time spent equals 2 points. Moderate equals 1 point. Lingering base equals 0. 3. Freshness, 1 point. If price has never returned to the zone since its formation, give it a 1. If it has already been tested or broken, 0. Fresh zones have unfilled orders. That's where the edge lies. 4. Clarity of the zone, 1 point. Is the base clean and easy to identify? Are the candles tight and readable? A visually clear zone gets 1 point. If it's messy, skip it. Remember, if you struggle to market, it's probably not worth trading. 5. Engulfing pattern before departure, 1 point. Did an engulfing candle, bullish or bearish, kick off the move from the zone? That's often a sign of large institutional interest. If yes, give it 1 point. 6. Location relative to structure, 2 points. This one's critical. If the zone is aligned with a higher time frame trend or forms near key support resistance, trend line, or Fibonacci level, give it 2 points. If it's neutral or questionable, 1 point. Against trend, 0. A great zone in the wrong place is a trap. Mot 7. Size of the zone, 1 point. Tight zones are more efficient and precise. If the zone is narrow and clean, ideal for stop-loss placement, give it 1 point. If it's wide and sloppy, it's less practical, 0 points. This scoring system becomes your personal trade filter, a psychological anchor that keeps you disciplined no matter how exciting a setup looks. The psychological edge. Now, let's talk about the hidden benefit of this system. By assigning a score, you're removing emotion from the equation. There's no second guessing, no impulsive clicking. You're following a repeatable process, and that creates confidence. Over time, Miller notes, traders who use this system stop chasing trades. They start hunting for quality. They take fewer setups, but with higher conviction and better results. You stop being a gambler. You become a strategist. Journaling the scores. Miller suggests a powerful habit. Record the scores of every zone you trade in your journal. Note the outcome. Did a 9-point zone work? Did a 6-point zone fail? Patterns will begin to emerge. You'll see what combinations deliver results and where you tend to make exceptions. This feedback loop makes you sharper with every trade. And eventually, your eye becomes so trained that you can spot a high-scoring zone almost instantly. Chapter 7, The Price Actions Messages, Learning to Listen to the Market. Frank Miller opens with a compelling idea. The market is always speaking. The question is, are you listening? Trading isn't just about spotting supply and demand zones. It's about understanding what the market is trying to tell you through price action, especially within and around these zones. This chapter teaches traders how to interpret those subtle but powerful messages. Miller reminds us, charts are not just patterns. They are reflections of human behavior, emotions, and institutional intent. Every candle printed on the chart has a story behind it. Learning to read those stories helps you anticipate price behavior with greater precision. Why price action matters so much. Think of supply and demand zones as potential battlefields. But how do you know who's winning, the buyers or the sellers? That's where price action steps in. Miller emphasizes that the behavior of price as it enters, interacts with, and exits a zone reveals everything you need to know about market sentiment. Instead of reacting late, you start anticipating. You're not guessing, you're reading the signs. Approach behavior, how price arrives at the zone. The first message comes before price even touches the zone. If price approaches a demand zone with small candles, wicks on the bottom, and low volume, it shows hesitation from sellers. Buyers may be preparing to step in. That's a good sign. But if price races into the zone with strong bearish candles and high momentum, it could break through the zone instead of bouncing off it. The message? The strength of the approach affects the strength of the reaction. Fast approach equals weaker bounce. Slow, respectful approach equals higher bounce potential. Mot 2. Reaction at the zone. The battle unfolds. Now, price touches the zone. What happens? Miller explains that the initial reaction tells you if institutions are defending that zone. A sharp bounce with large bullish candles from demand or bearish from supply signals strong orders and high conviction. A hesitant, choppy reaction with indecision candles, dojis, spinning tops, may mean the zone is being tested or even absorbed. Here, he introduces a subtle concept, absorption versus rejection. If the market is absorbing orders slowly, price may stall at the zone before breaking it. If there's a clear rejection, you'll see an aggressive reversal. Reading these candles gives you a front-row seat to the battle of buyers versus sellers. 3. Candle clues, the language of price. Frank Miller encourages traders to focus on a few critical candle types near zones. Engulfing candles, a strong signal of momentum shift, especially if it happens right at the edge of the zone. Pin bars, hammer candles, sign of rejection. When wicks show price was pushed away from the zone, institutions may be active. Inside bars, pause or build up. When you see multiple inside bars near a zone, get ready. It could explode soon. He reminds us, context is everything. A pin bar on its own isn't a holy grail, but a pin bar that forms after a slow approach and right at the edge of a high-quality zone, that's a conversation worth listening to. 4. Exit behavior. The follow-through tells the truth. After the zone reacts, what does price do next? Miller says follow-through confirms intent. If price reacts strongly from a demand zone and then breaks above recent highs with ease, that zone was legit. Institutions were likely involved, but if price reacts and then reverses back down quickly, it may have been a trap or a weak zone. Your job? Observe and adapt. Let price action confirm or cancel your bias. 5. Volume as a supporting actor. Though not the focus of Miller's method, volume spikes near zones often confirm hidden institutional activity. When a zone reacts and volume spikes, someone big is stepping in, but volume without price action context is noise. Use it only as supporting evidence, not a primary signal. Reading fakeouts and traps. One of the market's cruelest tricks is the fake breakout, where price briefly moves past a zone, triggering stop losses, and then reverses hard. Miller urges traders to be cautious. Watch for wicked candles that pierce a zone but fail to close beyond it. These are often signs of liquidity hunts. Recognizing these traps gives you an edge over those who panic. Miller closes this chapter with a gentle reminder. You don't need to predict the market. You just need to observe and react intelligently. Chapter 8. Flip zones. In trading, there are moments where the market shifts gears. What was once a strong resistance suddenly becomes support, or a demand zone that held firm yesterday now acts as resistance today. These pivotal areas are what Frank Miller calls flip zones. Imagine price rallies into a supply zone and gets rejected, classic scenario. But then, instead of turning back lower, price breaks through that zone and keeps climbing. Now that supply zone has lost its selling power, but that doesn't mean it's irrelevant. Quite the opposite. Once price pulls back to that same level, it often acts as demand, creating a flip. Same level, different behavior. That's the power of a flip zone. According to Miller, these zones represent a shift in control. Where sellers once dominated, buyers have now taken charge. And this shift is not random. It's often triggered by institutional orders getting absorbed, replaced, or reversed. Why flip zones are so powerful? Flip zones are one of the market's clearest confirmations of sentiment change. They offer two major advantages for traders. One, they confirm trend direction. When a former supply turns into demand, it reinforces that bulls are now in control. The trend is strong. 2, they offer high probability entries. Because these zones have a proven track record, they were respected once, then broken. They act as magnet levels where price often retests and continues. In other words, flip zones are both confirmation and opportunity. How to identify a flip zone? Miller breaks this down into a simple visual process. 1. Spot a clean supply or demand zone. Start with a well-defined supply or demand zone, something with a strong move away, few candles, and no prior tests. 2. Wait for price to break through that zone. If price cuts through with large candles, minimal resistance, and strong follow-through, it's likely that the original orders were overwhelmed. 3. Watch for the pullback. Now price starts to retrace. Watch closely as it returns to the broken zone. If the market holds there, opposite to the previous behavior, you've got a flip. Number 4, look for confirmation signals. Here's where price action matters. A bounce off the flip zone, rejection candles, or engulfing patterns confirm the shift in sentiment. This entire sequence shows that the market has changed its mind, and it's inviting you to follow its lead. Let's say price approaches a supply zone at 125.50 and sharply reverses. Great. But then later, price climbs back up and breaks right through that level. Now, 125 is no longer a barrier. It's a potential new floor. When price returns to 125.50 and you see a bullish engulfing candle or pin bar, that's your entry signal. You're not trading against the trend. You're trading with the new flow of power. Flip zones in ranging markets. Miller also explains that flip zones are particularly useful in sideways or choppy markets, where support and resistance keep switching roles. In these environments, being able to spot the flip before others gives you a huge edge. Instead of getting chopped up, you're trading with structure. Common mistakes to avoid. While flip zones are powerful, they require caution. Miller warns against trading before the flip is confirmed. Just because price breaks through a zone doesn't mean it's a true flip. Wait for the retest. Forcing flips in weak zones. Only use well-formed zones with strong structure. A sloppy zone won't flip cleanly. It might just fake you out. Ignoring trend context. A flip zone that aligns with the overall trend is much more reliable than one that doesn't. How to trade flip zones safely. Miller gives this practical approach. Entry. Wait for a clear rejection at the flip zone, pin bar, engulfing, or sharp bounce. Stop loss. Just below for demand flips or above for supply flips the zone. Target. Use the next zone in the direction of the move or a recent swing high-low. This setup lets you trade with confidence. You're entering where the market has already shown its cards. Miller concludes by reminding us, flip zones are not just technical levels. They're a reflection of the market's memory. They show where buyers and sellers have clashed before and where the balance of power has shifted. Chapter 9, Reversal and Continuation Trading with Supply-Demand. Frank Miller takes a deep dive into the two core types of market movements that traders face, reversals and continuations. Both represent different sides of the market's psychology, and Miller explains how to approach these movements with supply and demand analysis. Before diving into trading strategies, Miller defines reversals and continuations in the context of supply and demand. Reversals, a shift in market direction. For example, when price reaches a supply or demand zone, and instead of continuing the previous trend, it turns around. This is a reversal. Continuations, when price hits a zone and continues in the same direction, either moving further up in an uptrend or down in a downtrend. In these cases, the zone doesn't stop the trend, but extends it. Miller stresses that recognizing the right type of market movement is crucial. Not all supply and demand zones are meant to reverse trends, and not all will lead to trend continuations. Your job as a trader is to identify which one it is. Reversal trading with supply-demand zones. When it comes to reversals, Miller introduces a key principle. Strong supply and demand zones are often reversal points. 1. Spotting reversals. Reversals typically happen when price enters a well-formed supply or demand zone with high momentum and breaks out sharply from it. These zones are often untested and come after a strong market move. Example, if the market has been in an uptrend and you see a sharp drop into a demand zone and then price shows a solid bullish engulfing candle, this is your sign for a potential reversal to the upside. 2. Price action signals. Miller emphasizes that price action is key. Look for strong, clear signals within the zone like pin bars, engulfing candles, or hammer candles. These signals tell you that the buyers or sellers have taken control and the trend is likely to reverse. 3. Why these zones work for reversals. Reversal setups often occur in zones where price has either previously reversed strongly or where institutional activity is likely to initiate fresh buying or selling pressure. 4. Stop loss and targets for reversal trades. When trading reversals, Miller suggests placing your stop loss just below for demand or above for supply, the zone. Your targets should ideally be the next supply for a demand reversal or demand for a supply reversal zone. This gives you a high reward setup with low risk, provided the reversal is supported by solid price action. Continuation trading with supply-demand zones. On the flip side, continuation trading involves trading with the prevailing trend, riding the momentum rather than betting on a reversal. Miller explains that continuation trades are often higher probability since they align with the broader market direction. 1. Spotting continuations. A continuation trade happens when price hits a demand zone in an uptrend or a supply zone in a downtrend and continues in the direction of the trend. Example. Imagine the market is in an uptrend. Price pulls back into a well-formed demand zone without breaking it. If price respects the zone and continues upwards, this confirms the continuation of the uptrend. 2. The power of momentum. Miller stresses that continuations work best in trending markets. Strong trends have a higher chance of continuing once they hit a well-established zone of supply or demand. This is because the imbalance between buyers and sellers remains, and the trend is likely to persist as long as the zone holds. 3. How to trade continuations. Just like reversal trades, continuation setups require confirmation from price action signals. Look for sharp moves out of the zone or small consolidation patterns followed by big moves. Breakouts from consolidation areas or clear momentum candles signal the trend will continue. 4. Stop loss and targets for continuation trades. For continuation trades, place your stop loss just below the demand zone for buying or above the supply zone for selling. As for targets, aim for the next key resistance or support levels. You're aiming to ride the wave further along the trend. Miller also highlights the key differences between these two types of setups. 1. Reversal setups typically involve zones that have been untested or overextended, where price has broken the structure and is showing signs of a new direction. 2. Continuation setups are based on strong trends, where price simply retests the zone and continues without breaking previous structure. Chapter 10. Gap Trading with Supply and Demand. Frank Miller dives into the intriguing world of gap trading, one of the most exciting yet challenging aspects of trading. Gaps often create significant opportunities in the market, but Miller emphasizes that understanding how they relate to supply and demand zones is the key to trading them effectively. Gaps represent price dislocations, moments where price jumps over a level without any trading in between. These occurrences often come with substantial momentum and can be incredibly profitable if you know how to read and trade them. Miller shows us how to use supply and demand analysis to identify, interpret, and take advantage of these gaps. What are price gaps? First, Miller defines a gap as a situation where the opening price of a new trading period, like the next day or the next session, is significantly different from the previous closing price. This creates a gap in the price chart, which can signal a potential change in market sentiment. There are several types of gaps, but for the purpose of this chapter, Miller focuses on the two that are most relevant to supply and demand traders. 1. Breakaway gaps. These occur when price breaks out of a range or consolidating area and leaves a gap behind. The gap indicates a shift in market dynamics, either a breakout from a supply zone or demand zone. 2. Gaps. These happen near the end of a trend and often signal a potential reversal. These gaps occur when the market exhausts its current momentum and may quickly reverse. They often appear in an overextended market. Miller emphasizes that the key to trading gaps effectively lies in understanding their context, where they form in relation to supply and demand zones. Gaps in unimportant areas may be just noise, but gaps that occur at or near strong supply or demand zones can create incredible trading opportunities. How gaps relate to supply and demand zones. According to Miller, gaps can be thought of as a sign of a supply-demand imbalance. When a gap occurs, it often means that there was a surge in buying or selling pressure that couldn't be absorbed in the usual trading range. This creates a sharp move, sometimes far beyond previous levels. 1. Gaps at demand zones. When price gaps up into a demand zone, it suggests that there is unfilled demand beneath the market. In this case, the gap can act as a magnet for price, pulling it back to test the demand zone before the next move. Traders can look for bullish reversal signals at the demand zone to enter long positions. 2. Gaps at supply zones. Similarly, when price gaps down into a supply zone, it indicates unfilled supply above the market. This can cause a sharp reversal as the selling pressure is absorbed. If price returns to the gap area, it's often met with strong resistance from the supply zone, giving traders a chance to enter short trades. Miller stresses that these zones are critical for identifying where the gap will likely resolve. If the gap occurs far from any significant supply or demand zone, it may be best to avoid trading it, since the gap may be just noise. But when gaps occur at key price levels, they offer huge potential for identifying high-probability setups. Now that we understand the relationship between gaps and supply and demand zones, Miller shares his strategy for trading these gaps. 1. Identify the type of gap. Miller suggests identifying whether the gap is a breakaway gap or an exhaustion gap. Each type requires a different approach. Breakaway gaps. These are strong, one-way moves that signal the start of a new trend. These are usually traded in the direction of the gap. Exhaustion gaps. These occur at the end of a trend and often signal a reversal. These are best traded against the gap, anticipating a reversal at the supply or demand zone. 2. Wait for price action confirmation. Don't jump into a trade immediately after the gap. Miller advises waiting for confirmation, either a price action signal, like a pin bar, engulfing candle, or hammer at the supply-demand zone, or a pullback that tests the gap area. This confirmation will help you avoid false breakouts or gap fills that don't lead anywhere. Number 3. Target the gap's fulfillment. A key rule Miller gives is that gaps often get filled. If the gap creates a significant imbalance in supply and demand, the price will likely return to the gap area at some point. Traders can target the gap fill as their initial profit target, with additional targets based on the next supply or demand zone. Let's consider a breakaway gap that occurs in an uptrend. Price gaps up into a strong demand zone, showing that buyers are in control and willing to pay higher prices. Miller suggests looking for bullish price action, like an engulfing bar, when price retraces back into the gap area. Once confirmed, this is your opportunity to enter long with a target at the next resistance level, likely in the form of an untested supply zone. In contrast, with an exhaustion gap in a downtrend, price gaps down into a strong supply zone. Miller suggests waiting for signs of reversal when price tests the gap area. Look for bearish price action signals, such as a pin bar or engulfing candle, which can confirm the beginning of a reversal. You'd enter short with a target at the nearest demand zone, where the price might find support. The risks of gap trading. Miller also highlights some risks associated with gap trading. Gaps can lead to false breakouts or get filled quickly, especially if the gap is not based on solid supply-demand dynamics. It's essential to wait for price action confirmation before entering a trade to avoid being caught in a false move. Also, gaps that occur in choppy or sideways markets tend to be less reliable. Gaps in strong trends, however, are usually high-probability trades and offer better setups. Chapter 11, CCI Techniques, Enhancing Your Strategy with the Commodity Channel Index. Frank Miller introduces the Commodity Channel Index, CCI, as a powerful tool that can complement supply and demand analysis. He explains how this momentum oscillator helps traders gain a clearer view of market conditions, pinpointing overbought or oversold conditions, and improving the precision of entry and exit points. What is the Commodity Channel Index, CCI? The CCI is a momentum-based indicator designed to measure the deviation of price from its average price over a specified period. Essentially, it calculates how far the price has moved from the average over a set time frame, with values typically ranging from -100 to +100s. Above 100, the market is considered overbought, suggesting that the price has risen significantly above the average, and a potential reversal or pullback might be on the horizon. Below -100, the market is oversold, implying that the price has dropped below its average and may reverse or experience a bounce. Miller highlights that the CCI, by focusing on price deviations, gives a more dynamic understanding of market momentum. Unlike other indicators that lag behind price movements, the CCI aims to anticipate price movements, making it a valuable addition to a trader's toolkit. Why combine CCI with supply and demand? Miller stresses that while supply and demand analysis shows us the zones where price is likely to reverse or continue, the CCI provides additional confirmation on whether the price is overextended within these zones. Here's how the two can complement each other. 1. CCI for momentum. The CCI reveals whether a market is in a strong trend or showing signs of overextension. When combined with supply and demand analysis, it can give you a clear idea of whether a price is ready to reverse at a demand zone when the CCI is oversold or a supply zone when the CCI is overbought. 2. Early signal for reversals. While supply and demand zones tell us where reversals are likely, the CCI helps us pinpoint when those reversals are likely to occur. A CCI turning from overbought to neutral or oversold to neutral within a supply or demand zone is often a strong indication that a price reversal is imminent. 3. Validating continuations. When trading continuations, the CCI helps confirm that price is not overextended within the trend. If the CCI is above 100 in an uptrend, it might be a sign that the trend has strength and can continue. Similarly, if the CCI is below -100 in a downtrend, it confirms that the trend still has momentum. How to integrate CCI into your trading strategy. Miller explains that effective integration of the CCI into a supply and demand-based trading strategy requires a few key steps. Let's break them down. 1. Identifying market conditions with CCI. Overbought, oversold conditions. First, use the CCI to identify if the market is in an overbought or oversold condition. This is crucial because trading solely from supply and demand zones without considering momentum can lead to false signals. CCI helps avoid these by showing when the price has moved too far too fast. Trend direction. When the CCI moves above 100, it signals a strong bullish trend. And when it moves below 100, it indicates a strong bearish trend. These are important to watch because they highlight whether the market is showing momentum that will likely continue or momentum that is starting to fade. 2. Confirming entry points. Miller suggests that after identifying the supply or demand zone, wait for CCI confirmation. For example, if the price is approaching a demand zone, look for the CCI to be oversold below 100. This combination suggests a strong likelihood of a bullish reversal. If the price is approaching a supply zone, look for the CCI to be overbought, above +100. This signals that selling pressure is likely to come in and may lead to a downward reversal. A CCI turning from extreme levels, overbought or oversold, to neutral, while prices near key levels can serve as an early confirmation of the market's reversal. 3. Exit strategies with CCI. The CCI also provides useful exit signals. For instance, when trading a reversal setup, if the CCI turns neutral or crosses back into the normal range, 0, it's often a sign that the momentum has faded and it's time to consider closing the position. For trend-following trades, if the CCI stays consistently above +100 in an uptrend or below -100 in a downtrend, it can help confirm that the trend has strong momentum and might continue further. 4. Divergence with CCI. Another powerful strategy is using divergence between price action and the CCI. When the price is making new highs or lows, but the CCI fails to make new highs or lows, i.e., bullish or bearish divergence, this is a potential sign that the trend is losing strength and could soon reverse. Divergence is a strong confirmation signal that traders should watch closely. Let's walk through a practical scenario. Suppose price has been trending upwards and you identify a demand zone on the chart. The CCI has moved below 100, indicating the market is oversold. As price approaches the demand zone, you wait for the CCI to cross back above -100 and show bullish momentum. When the CCI begins to turn positive, you can then confidently enter the trade, knowing that the price has likely found support at the demand zone and momentum is shifting in your favor. Your stop loss can be placed just below the demand zone, and your target could be the next resistance zone. Chapter 12, Multi-Frame Analysis 101. Frank Miller introduces the concept of multi-frame analysis, a crucial technique that provides traders with a comprehensive view of market dynamics. By analyzing multiple time frames, traders can gain a deeper understanding of price behavior, identify trends, and make more informed trading decisions. Miller argues that without considering different time perspectives, traders may miss key opportunities and fail to see the bigger picture of the market. Why use multi-frame analysis? The primary goal of multi-frame analysis is to provide a holistic view of the market. Traders often rely on a single time frame to make decisions, but this can be limiting. Price action in one time frame might look very different from the price action in another time frame, and by focusing on only one time frame, traders may miss important information. Miller highlights the limitations of using only one time frame. 1. Short-term volatility can often confuse traders who only look at small, fast-moving time frames. 2. Long-term trends may be difficult to spot if a trader is solely focused on shorter time frames, leading to missed opportunities for swing trades or position trades. By using multiple time frames, traders can see how short-term price action fits into the context of long-term trends, helping them make better decisions. Miller calls this technique the art of trading with perspective, looking at the market from various angles to get a complete view of the situation. Miller explains that the key to successful trading is to combine the best aspects of short-term and long-term analysis. Here's how multi-frame analysis enhances trade accuracy. 1. Confirming trends. When you analyze multiple time frames, you can confirm the direction of the trend. For example, a long-term trend might show that the market is bullish, but a short-term chart might display short-term fluctuations that could lead to temporary pullbacks. By confirming the bigger trend on the higher time frames, you can trade with the trend, which increases your chances of success. 2. Identifying key levels. Supply and demand zones are crucial in trading, and multi-frame analysis helps you spot these levels more accurately. A demand zone on a higher time frame, such as a daily or weekly chart, may provide a stronger level of support, while a shorter time frame, like a 5-minute or hourly chart, can show you entry opportunities within that broader level. By analyzing both, you can enter trades with a clear sense of risk versus reward. 3. Timing entries and exits. One of the most critical aspects of trading is timing. By analyzing multiple time frames, you can pinpoint exact entry points and exit points. For example, you might use a higher time frame to determine the trend direction, and a shorter time frame to identify precise entry points when the price approaches a key zone. This approach helps you avoid entering trades prematurely or too late. Miller suggests a practical strategy for multi-frame analysis that involves 3 different time frames: the higher, intermediate, and lower time frames. Let's break down how this works. 1. Higher time frame, trend analysis. The higher time frame is where you focus on the overall market trend. This could be the daily, weekly, or even monthly chart, depending on your trading style. The purpose of the higher time frame is to get a sense of the big picture, whether the market is in an uptrend, downtrend, or range-bound. By identifying the prevailing trend, you can trade in the direction of the trend to improve your odds of success. For example, if the market is in a bullish trend on the daily chart, you can look for buying opportunities on the lower time frames. 2. Intermediate time frame, structure and context. The intermediate time frame serves as a bridge between the higher and lower time frames. This could be a 4-hour or 1-hour chart. On this time frame, you can analyze the price structure, identify key support and resistance levels, and spot pullbacks or retracements within the overall trend. This time frame helps you refine your trading strategy by providing more context for the moves you see on the higher time frame. For instance, if you see a bullish trend on the daily chart and spot a pullback to a demand zone on the 4-hour chart, this creates an opportunity to enter long trades. Number 3, lower time frame entry and exit. The lower time frame is where you fine-tune your entries and exits. This could be a 15-minute, 5-minute, or 1-minute chart, depending on your trading strategy. Here, you'll look for precise entry signals, such as price action patterns, candlestick formations, or technical indicators to enter trades. The lower time frame helps you time your trades more accurately while still aligning with the overall trend seen in the higher time frames. For example, you might spot a bullish engulfing candle at a demand zone on the 5-minute chart, giving you the green light to enter a trade in the direction of the trend. Best practices for multi-frame analysis. Miller shares several best practices to help you maximize the effectiveness of multi-frame analysis. 1. Align with the higher time frame trend. Always ensure that your trades align with the higher time frame trend. Trying to trade against the main trend can be risky, even if short-term signals seem promising. Stick to the trend to improve the probability of success. 2. Use intermediate timeframes for structure. The intermediate timeframe helps you refine your analysis. Look for support resistance levels and pullbacks on the intermediate timeframe to identify better entry points and manage risk. 3. Wait for confirmation on lower timeframes. Don't rush into trades based on lower timeframe signals alone. Always wait for confirmation that the price is moving in your favor before entering. Look for price action patterns or momentum indicators to validate your entry.
Order filled.
4. Avoid conflicting signals. Be cautious if the signals on the lower and higher timeframes conflict. For example, if the higher timeframe shows an uptrend, but the lower timeframe shows a downtrend, it may be better to wait for clearer alignment before making a trade. When combined with supply and demand analysis, multi-frame analysis becomes a powerful tool for identifying high-probability setups and executing successful trades. Chapter 13, Trade Examples. Frank Miller takes a step further by presenting real-world trade examples that illustrate how traders can effectively apply the supply and demand concepts and strategies discussed throughout the book. These examples not only serve as practical demonstrations, but also provide valuable insights into decision-making processes, trade management, and risk control in live market conditions. Understanding the trade examples. Miller starts by noting that successful trading isn't just about recognizing supply and demand zones. It's about understanding the market context, market sentiment, and being able to time your entries and exits correctly. He shares several trade examples that illustrate how a trader can take advantage of price imbalances in the market. Trade example 1, reversal trade at a demand zone. In the first example, Miller walks through a reversal trade that took place at a demand zone. He explains the importance of identifying key price levels where the market has historically reversed. Here's how the trade unfolded. 1. Identifying the demand zone. The trader recognized a strong demand zone on a 4-hour chart where price had previously bounced. This level had held multiple times in the past, showing strong buying interest. 2. Waiting for confirmation. Instead of entering the trade immediately upon price reaching the demand zone, the trader waited for confirmation signals. These included price action patterns, like a bullish engulfing candle, and momentum indicators, such as the CCI crossing above minus 100, which confirmed that the market sentiment was shifting from bearish to bullish. 3. Entry. The trader entered the market at the break of the bullish candle with a stop loss just below the demand zone, managing risk carefully. 4. Exit. The trade was exited when price reached the next resistance zone, where selling pressure was anticipated. The risk-to-reward ratio was favorable, with the trader achieving a profit of 201 on the trade. Key takeaways from example 1. Patience is essential when trading supply and demand zones. Waiting for confirmation signals ensures a higher probability of success. A trader should always have a well-defined stop loss to manage risk. Timing is critical. Waiting for a clear reversal signal gives you an edge. Trade example 2. Continuation trade at a supply zone. In this next example, Miller demonstrates a continuation trade at a supply zone. He explains how the trader used multiple timeframe analysis to confirm the setup. 1. Identifying the supply zone. The trader identified a strong supply zone on the daily chart where the price had previously dropped sharply. The CCI indicator was also showing an overbought condition on the higher time frame, confirming that price was likely to face resistance at that level. 2. Confirming with lower time frames. The trader moved to a 4-hour chart to refine the entry. On the 4-hour chart, price showed signs of exhaustion at the supply zone, with a bearish engulfing candle forming as price approached the zone. The trader saw this as a clear signal that the supply zone would hold and the market would continue its bearish trend. 3. Entry. The trader entered the trade when the price broke below the low of the bearish engulfing candle, with the stop loss placed just above the supply zone to manage risk. 4. Exit. The trader exited the trade when price reached a demand zone lower down the chart, which provided a logical exit point. Key takeaways from example 2. Multi-frame analysis is critical for confirmation. The daily chart provided the big picture, while the 4-hour chart refined the entry. Identifying price exhaustion patterns, like bearish engulfing candles near key zones, is a strong signal for continuation trades. As with reversal trades, having a clear exit strategy is key to protecting profits and minimizing losses. Trade example 3, gap trading with supply and demand zones. In the third example, Miller demonstrates how gap trading can be integrated with supply and demand analysis. Gaps in price occur when the market opens at a significantly higher or lower price than the previous close, often signaling a strong shift in market sentiment. 1. Identifying the gap. The trader noticed a gap that formed in the early hours of the market session, creating a significant price discrepancy. The gap occurred near a supply zone, which suggested that the market might face resistance at that level. 2. Waiting for the gap to fill. Instead of jumping into the trade immediately, the trader waited for the gap to fill, which happens when price retraces back to the level where the gap started. This is a common pattern, and filling the gap can provide a high probability entry point. 3. Entry. The trader entered the trade when price approached the supply zone again and showed signs of rejection, such as price candles with long upper wicks. The stop loss was placed above the gap high to limit risk. 4. Exit. The trade was exited when the price moved into the next demand zone, providing a logical and profitable exit point. Key takeaways from example 3. Gap trading can be an effective strategy when combined with supply and demand analysis. Gaps represent market imbalances, and filling those gaps often leads to reversals. Patience and precision are essential in gap trading. Waiting for the gap to fill before entering can provide better risk-to-reward opportunities. Always monitor price action near key zones to confirm that your entry is valid. Chapter 14. Risk Management in Trading. Protecting Capital and Ensuring Long-Term Success. Frank Miller wraps up the book with a crucial topic that can make or break a trader's career: risk management. Miller emphasizes that no matter how skilled a trader is in identifying supply and demand zones, applying technical indicators, or using multi-frame analysis, without effective risk management, long-term success is impossible. In this final chapter, Miller explores several risk management techniques that help traders protect their capital, manage potential losses, and stay in the game for the long haul. Miller begins by explaining the fundamental principle of risk management: protecting your capital. A successful trader doesn't just focus on making money, they also prioritize avoiding unnecessary losses. No matter how accurate your analysis or how well you spot trade opportunities, you can lose everything if you fail to manage your risks properly. Miller stresses that every trader should have a well-defined risk management plan before even considering entering a trade. Risk-to-reward ratio. One of the key risk management concepts that Miller introduces is the risk-to-reward ratio, which is a measure of the potential reward of a trade relative to its risk. The risk-to-reward ratio is a simple yet powerful tool that helps traders assess the profit potential against the possible loss of each trade. 1. Setting a favorable ratio. Miller recommends aiming for a risk-to-reward ratio of at least 1:2. This means that for every dollar you're willing to risk, you should expect to make at least $2 in profit. If your risk-to-reward ratio is less than 1:2, you're likely taking too much risk for too little potential reward. 2. Why it matters. The risk-to-reward ratio is essential because it helps traders evaluate the viability of a trade. Even with a high win rate, if your risk-to-reward ratio is unfavorable, a few big losses can wipe out all your gains. On the other hand, a favorable risk-to-reward ratio can allow traders to remain profitable even if they don't win every trade. Miller emphasizes that maintaining a positive risk-to-reward ratio is critical to long-term profitability. Traders who are consistently wrong on a few trades, but still manage to have larger wins on successful trades, will be able to grow their capital steadily over time. Position sizing. How much to risk? Miller explains that position sizing is another critical aspect of risk management. Position sizing refers to determining how much capital to allocate to each trade. This decision has a direct impact on how much you can afford to lose without damaging your account. 1. Fixed percentage. One common method is to risk a fixed percentage of your total trading capital on each trade. For example, if you risk 2% of your account balance per trade and you have a $10,000 trading account, you would risk $200 per trade. If the trade hits your stop loss, you lose $200, but you are still protecting the majority of your capital. 2. The importance of consistency. Miller stresses that consistency in position sizing is key to controlling your risk. If you risk too much on any given trade, a string of losses can quickly deplete your capital. By risking only a small, consistent percentage of your account balance on each trade, you give yourself a much better chance to survive losses and bounce back. 3. Adjusting position size based on volatility. Another advanced technique that Miller discusses is adjusting your position size based on the volatility of the market. In volatile markets, the price can move rapidly in either direction, which increases the risk of larger drawdowns. In such cases, you should reduce your position size to account for the higher risk. Stop losses. Protecting your capital. One of the most important tools in any trader's risk management toolkit is the stop loss. A stop loss is an order placed with your broker to automatically close a trade at a specific price if the market moves against you. The goal of a stop loss is to limit losses on a trade, preventing a small loss from turning into a much larger one. 1. Using stop losses wisely. Miller advises placing stop losses at logical levels, such as below a demand zone when buying or above a supply zone when selling. Setting your stop loss too tight can result in getting stopped out prematurely, while setting it too wide increases the risk of large losses. Finding the right balance is key. 2. Adjusting stop losses as the trade moves in your favor. Miller also introduces the concept of trailing stop losses. As the trade moves in your favor, you can adjust the stop loss to lock in profits. For example, if the price moves 50 pips in your favor, you can move your stop loss to break even or a profit point, ensuring that you don't lose money on a winning trade. 3. The psychology of stop losses. One of the biggest psychological barriers for traders is accepting a loss. Miller highlights that accepting small losses is crucial for long-term success. Traders often hesitate to use stop losses or move them in order to avoid admitting defeat, but doing so exposes them to much larger losses that could wipe out their capital. Risk management strategies for long-term success. Miller provides several strategies to maintain long-term profitability. 1. Trade only when the odds are in your favor. Not every trade will offer a favorable risk-to-reward ratio or align with the market's trend. Miller advises waiting for setups that meet all criteria before entering a trade. Trading when the odds are stacked in your favor increases your chances of success and reduces unnecessary risks. 2. Never risk more than you can afford to lose. This sounds basic, but Miller underscores how easy it is to over-leverage in pursuit of quick profits. He advises using small position sizes and never risking more than a small percentage of your total capital. 3. Diversify your trading strategy. Risk management isn't just about controlling individual trades, it's also about controlling your overall trading portfolio. By diversifying your strategies and trading different assets, you can spread risk across multiple markets, reducing the impact of a loss in any single asset. The goal is not to avoid losses entirely, but to minimize their impact. By focusing on consistent risk-to-reward ratios, position sizing, and stop-loss techniques, traders can protect their capital and ensure that their trading journey is sustainable and profitable over time. And that's a wrap for today's video, friends. I hope you found this deep dive into supply and demand trading insightful and that it helps you sharpen your trading skills. If you enjoyed the content and found... Hello, friends. Welcome back to the channel.
check, 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 check. Yeah, I just testing the strat. It looks like we want to sell off. Just looking at everything that I see. I tested that bounce. We'll see what's all going on here. I can't remember exactly what time I posted that over in the Discord. But yeah. We're gonna go try to fill a gap. What are we doing here? Are we gonna go get this money to run it up? We're just gonna go get Asia lows. I'm gonna give it a little bit of time. I should have waited on that 30-minute or into this Europe session. What was that? That was 15. That was 30. I was hoping to see something like what did it do that at? Yeah, it was indecisive here, so I should have waited 3 more candles, or at least to this candle here. No, I would have just known that it was a sale. I got in a little early. It happens, you know. Still ain't hit my stop loss if I bought it. There you go, talking early. Yeah, so here's the confluence, and we can break this down a little bit more over on trading view because it got a little real time, so we can still watch it. It's 15-minute chart, sold up and continue to sell up, and then this time sold off, continued to sell off, and then it sold up in the U.S. market. Go back some more. Sold off, tried to get all whippy and stuff, and sold off some more, then everything sold off. So we gotta just, you know, I think that was that trying to go get a gap or something? I don't know what date this was. I'm not even gonna get that far off into it. Now I barely use this chart over here, and just so we know, do your own research. This is not financial advice. This is not financial advice. But yeah, I put this out here a little bit ago. Definitely was in the Discord. When did I take a break? I took a break around 9:30, 10 o'clock. So this was sitting here 9:30, 10 o'clock. All off in the Discord. I didn't want to sell. I took a major drawdown. I'm flat across all accounts. When it comes down to Top Step, I know they're probably upset with me a little bit. Just a little bit. I'll be talking to somebody tomorrow. Hopefully I can get in touch with risk management, see what I need to change up. But yeah. Really, they're just going to tell me to size down. I added some size on today. Or yesterday, let me say. I'll get this trade out the way. This is my overview. Started off the day, right? And I'll walk you all the way through it. Let me get back over to the Top Step. So we'll stay here. I'm not taking the trade right now. I'll wait. I got the patience because I got the drawdown. I started off this morning right here. 5 cattle trade. Trade was there. Trade was there all day. Right? I said, wait. I'm going to lock myself out the first 30 minutes, right? So here goes 8:30. And let me show you what I had whipped up in the kitchen over this way. Let me get to it. Give me 1 second. I'm going ahead and get the. So this was the other day, right? I'll give y'all a little sneak preview of the Discord. Do your own research. This is just, what I see. And, we call it out or whatever. But this is right off the bat. This is over the weekend. I'm looking at this trade. This is recapping over the weekend. This is Wednesday trade for the cattle. Right? There's some cool guy stuff going on here. How to do it. This ain't a guessing game. It's precision execution. Every tick tells a story. Every move has its motive. That's what it should have said. Identify the herd, trend, 15-minute, hour. That's definitely for how the cattle trade moves, right? If you ever just watch the chart, I've been watching the chart over there for a minute. I just started placing trades. I think this is my second or third day placing the cattle trade. This is my second day for real placing the cattle trade. I threw something against the wall in the practice account. But this is my second time. I've been watching this for a little while, right? You gotta corner the market. Make sure you know where the trap zones are, the stop hunts, and the value areas. Where that fair value wage is at, or whichever way you want to call it. Whatever that ICT concept is, it works. You just put it to your repertoire and keep on moving. Right. So we go back to the chart. I was locked out until about what? So I locked out, let's say, I believe 15 minutes of the market. All right. And I chased it. And it ran my stop because I caught it somewhere in here. If I locked out for 15 minutes, right? And this candle was moving up and down all crazy. Let's go to the 1 minute. So, this is 8 o'clock, 8:30. I locked out around, we'll say, 7:50 my time. So I traded here. Got ran from my stop. Real tight stop. Then it continued to do its thing. And then I tried to sell it again. Or no, I think I tried to buy it again. Because I just knew that it was going up. Market does what it wants to do. And around 10:30, I say, hey, it's 11:30, 12 o'clock. They're not trading this anymore. It balanced, and then it chose a direction and stayed that direction the rest of the day. So it ran my stop, and it came back up. Settled above. I'll be watching this trade tomorrow. Just merely watching it. Line to line, take profit. And I move, and that's the crazy thing about it, right? So you see where this is at. This has been here all day. If I move, if it was a fifth, right? I would have never hit my stop loss. No matter where I bought it at that second time I tried to buy. If I bought it even lower at a better price or added into size there, never hit my stop loss again. So the trade was there, the setup was there. My execution, fucking shitty. So I saved me some room, just a mere bit of it. So I won't be trading cattle. I have no room for cattle. I'm back off into the micros. I might even be trading micro ES because of the fact of I'm an idiot when it comes to, no, I won't say that. I'm not even going to put that in the universe. I didn't execute well today or yesterday. So we're overviewing, right? I didn't execute well at all. I made a couple more mistakes just like so. I entered into where my entry point was at rather than entering in where my stop loss was at. I don't know why or for what reasons, but it kind of works out. Even if it gets close, it always almost ticks me up, but it never ticks, when I do that. If you know, you know. I got some things in the works right now. I'm trying to take 5 combines over to the XFA now. Took out a payout over there in my Apex, or within this Top Step account. Take these 5 combines I got lined up. Take them over to the XFA. Once we do that, we're going to go live. I'm gonna say the rest of it. We're gonna do some Degen type shit. I can say whatever the hell I want now because nobody watches it, right? It's only me and my light. So everybody will be able to go back to this 256, 424, 25. But yeah, that was my counter trade. I'm not even fucked off about it. Let's go back to the MQ. Oh, that's what happened there. And let's continue to sell off. I tried to get against the trend. I was hoping for a reversal somewhere in here. It looks really strong, but I guess it's gonna be strong for the US tomorrow. So they're just trying to get everything they can if you're looking at it like battleship. But still never hit my take profit or stop loss, I'm sorry. If I sold it, it never hit my take profit. I guess it just hit my take profit if I sold it. And then I buy it again down here. Right? And send it back up. So we got some time. I'm looking for my trade for the session where I'm in profit. If I get whipped out in the US, I'm in good profit where, it's okay. This is what I do and how I do it. I've been executing pretty well, but that changes right now. The biggest contradiction of it all. Ain't none of your damn business. 365 Degen. basically what I'm saying is every time my little calculated lines here get touched, right? Get ready to sell, right? Just not financial advice. This is me walking through my live journal, right? And then sometimes it has a little bit more of a breakout, then it travels sideways, and then it falls back through that support. So this might be the breakout. A little bit lower, higher low. All right, these wicks are at. Could even try to run this full body of this candle here. All right. Fall back now. But that be the time that I try to sell it, right? And it runs all the way up and touch this other line up here. We're coming out that this silver bullet. I'll show you again over on my trading view. Pop that open. We're coming up out of that silver bullet, you see. It fell through the level. So screw that reversal. We're gonna reverse the other way. Well, we might go pick up these lows. That's my next eyesight there. I just dropped random lines. We're gonna see how these random lines play out. You know what I mean? And we got some gappage down here. There's no telling. We can clear it. This will be the real. Tell you the real. Like it's just in the middle of nowhere right now, so that's how I really feel about it. In the middle of nowhere. Not technically in the middle of nowhere. We got some more information on where this indicator came from. It's an original script. I don't know if it's for the free yet. I don't know if I like it all the way yet, but you know. We'll update this. Trading the EUR Session. Do your own research will say not financial advice instead of be right back. But you know. I'm looking to figure out what this is going to do from here. This is my confluence to sell. I should have retested, that retest here. I retested in the wrong spot rather than just selling and holding from here. And it bounced, right? Had a pop, and then it sold off. If I drop the trend line, we'll see what I'm talking about here, right? Had a little pop, and then now it's coming back to the trend line, even if I put it here. So do the same thing. I'll be looking for a breakout if it does it again. That heavy to the upside. Some form of breakout, but it could be a fake out breakout, like right here and right here. So, and what time was it when I put in this? It was 9:30. So like around 9:30, it was still trending downward. I think I was here. That was supposed to be a breakout. I said, nah, I don't think so. And we got all rangy and whippy and shit. I left it alone. So that's where we're at. Oh, Dorito. Yeah. Just a sell. And I come over here to these lower time frames. I forgot we even got this on lower time frames. Wow. This is not the original. See, that's another thing. This is MP2. So let's go. I lied. I'll show you some cool guy stuff instead. Give me a second. This is short, sweet, and simple here. 15 minutes. I think it works in the lower time frames. Yeah. And I just added New York Session high and lows. I can actually take those. Well, I'm gonna leave those still like those. So yeah, this is the cool guy stuff. And you just see the steps down. I wanted to create something like that. You also see the steps up. I mean, so, and so we can go to the step further down. Any further than that, we're in a run for it. I would like to see a huge reversal if that's the case. Get all the way down there. It gets all the way down there. I'm looking for the, the upper band all the way over again. You can almost, I don't know if you can, I've been reading this chart for a bit, so it makes sense to me from out here. I would like to overlay it with some market profile. What's market profile, you could ask? Market profile. Right. Actually, that might work. We'll get back to that. We gotta read back up on that. So yeah, a little bit further. Time frame doesn't like that, like 15 minutes and below, but I like it in the 30-minute time frame. That's a smooth read right there. I would still like the candles instead though. Gotta figure that out with this algo here. Price is down here. See, because I couldn't find the price. I think I might be able to. I don't know. I have to go back to. I'm in trading zone. We got A, B, C, D, E, F, G, H, I, J, K, L, M, N, O, P, where L go, P, Q, R, S, T, U, V. And it's not really single printed back here, so guys, it's heavy. All right, means it's heavy here, right? Single print, but it's got a lot of money that it can bounce off of. Got a lot of money it can bounce off of. Value area high, value area lows. So we're under the value area lows this week. Tuesday, sorry, Monday. I wish I had the candles on here. So I see a lot of bouncing, especially if we get down in here. Just send it. And then a stall. Then a stall here. then the stall there. There are major stalls here. This is which way you want to read the market. I usually have something up like this here on the screen, just so I can read this. Let's see where my single prints are at. See how this is doing right now. See how I just printed and use. So if it gets down here and prints one by itself, and come back up, we got another single print. But to find out what's going on with this, we know what's going on with it. I mean, I'm saying it right here. Point of correction. Way back here, got a lot of money. Single prints here. It's heavy here. I don't know what this is. That's different. This is what I want to look for. So yeah, no. Let's get heavy until back here. Under this point of correction back here from Tuesday, 15. It's iffy. It's tricky to rock or rock to rock. Let's see what the rank will look like. I forget what time frame you gotta watch this on. I'm not getting all into this though, cause it's a couple different. I'm not getting into all that. Because in order to work this, maybe we do it one day. But in order to work this, you work a couple of different indicators alongside of it. And I forgot how you do it too. 3 and sell, 2 and sell. You just look back at what it does last couple of times. All this has some confluence here. So I'm not gonna hurt my head and try to read that again. And get off of that before I get lost. I remember how to do it. I'm just not gonna set it. I'm not set up to trade like that right now. It's been a while. Really like the market profile. And you got a whole bunch of cool guy stuff. Find one thing you like and stick to it. It's just this. I guess I am IC10. I use it as an indicator. It's easy to go with a clean chart. These kind of, I don't know how to express it. It was definitely 30 seconds. So what the hell's going on here? Let's go back to main points. Hold on, wait. If I was trading this like a meme coin, how would my life be? There's a range. There's definitely damn range there. Gee. I just want to look at this and see how it is. It's going to go up and touch the top and come right back down on the 15-second chart. I haven't done this one yet. I think we messed those type of moves. Maybe not. That would be a buy, technically paper hand in it, on a 15-second chart. Let's see it. I would have technically, yeah, I would have got in. So my stop loss, there it is. Hunt that stop loss. Yeah. I would do some work on the 15-second chart to even. I gotta do work in NASDAQ. I place my entry in instead of placing my entry inside of the 1 minute. Get all the way nasty with it. Let's see what it looks like over on Top Step. Let's see what a 15-second chart really looks like. It's 5 seconds. Now you're fucking tripping. If you're doing that, you might want to go see counseling. 5 seconds. What the fuck? 15 seconds. Yeah, I don't know if I can pick that up over there. Just selling off though, I do see that. Sure is selling off. Oh, this reminds me of Bitcoin, or not Bitcoin, meme coins. Volatility. Look at that big ass round number. Look at that. You know what? I'm tripping. 5 minutes. Alright. What we gonna do from here? 3:30. We're gonna sell. This will be the time I get whipped out. 5-minute time frame. The pop 30-minute. What do we say here? Speed time, I would sell. Gap down is too close to the gap not to. Just halfway through that motherfucker. Get back over here. You scared to go to church, right? Bull flags everywhere. It's a lot cleaner chart. Look at that crap. Where was this at? 22, 20, yeah. Christmas tree. Oh, Christmas tree. Oh, Christmas. Okay. Yeah, I'm gonna chill out, man. That's a sell though, because it's not wanting to push back. I got some time to build it back. It's 333. We'll see what Deanna talking about. She ain't trading no nasty girl though. That's stack. Alright, y'all. I know what it is.
Figure out what copper wants to do. Obviously, it's been on a pretty strong uptrend recently due to the tariff news. Is it time to maybe have a bit of a pullback? Maybe. Although I'm not going to be biased. I'm not going to come into the whole day and just go, yeah, we'll sell copper. I want to see what they want to do with it. Right now, signs are a little bit messed up. We do have a very small initial balance, but yeah, I need to keep in mind that the rollover is definitely on the way, so we don't want to be caught in quieter days as a result of the rollover. Okay. Wizard TP says, hey D, I passed my first evaluation today VWAP Dakota's team. Well done, Wizard TP. That's very good to hear. Congratulations. That's very good. Now, please keep it sensible in the new XFA, okay? We don't want to see anyone blowing out in 1 day or 2 days, which is something that we have been seeing quite a bit. Yeah, so just, put some shackles on you. Save yourself from yourself. And then, be sure to start that XFA very slowly. Be more selective and all of that good stuff. So let's see if we can actually get you into profits and not blowing up. That is the whole point of guiding you through the VIP sessions. We're actually starting another season now. If you are looking to join the VIP, then keep an eye out during the broadcast, the main broadcast, for that link to sign up. We're also doing things like Top Quiz, where you can get an extra entry from winning Top Quiz and all of that good stuff. All right, so very small initial balance on copper. So let's zoom out. Let's turn into an eagle and see what we have on the daily chart. I was talking about this low volume area yesterday, wasn't I? This one here, or was it 2 days ago? I don't know. The time is just, all of the days are just blending into one. Yeah, so the low volume area, I said we could move quickly through it or away from it, which is what you expect to see when you run into an LVN. That's exactly what we're seeing here now. We got up there, hit a smaller supply area that was pretty strong, along with the LVN, and promptly ran away from it, scurried back the other way, right? So we're going to see whether that might continue. So that's the only reason why I'm kind of just a little bit on the short side. But again, keeping my eyes open, keeping my mind open for both sides of the picture, of the story. I like to look at the price action developments as a story, kind of like a symphony with different instruments all having their own place in my methodology, right? Of course, I was a musician for a long time. So what do we have? We have a bit of an expansion of the range here after the Asia trading. Asia didn't give it some mad trend. In fact, I would argue this is pretty muted. So not too much to glean from that. On the profile, oh, that's loud. On the profile, we are opening below value. Who's we? Copper is opening below value with a little bit of a gap down. Now that could bring a potential for my first hypo, mean reversion up. So basically going back where it came from. Let's put that down. So hypothesis 1. Now sometimes if you are looking at a setup, sometimes it's not playable. You know, it might be happening in front of you, but maybe the candle that did the breakout was too big. Maybe maybe it was too quick for you to catch. Maybe some things weren't as clear. Maybe you have a tape bomb or something. Now, if we ever get it back up to the value low, I would be interested in value low reversal. So maybe somewhere between the value low and GEX2 area. Value acceptance would be a little bit too late at that point. So even if that happens, I wouldn't be really interested in that. Now, if we end up not even being able to sustain above the initial balance, because if you see this little rectangle on my chart, the red one, that's initial balance. So if we manage to go below it, so below this put support area, we might have possibility for something that I call an asymmetrical neutral day down. And if we get to COMEX and we're still a little bit quiet or not really doing much, this whole idea might change drastically, because we will have the value areas completely different. Now, for the COMEX session, I did notice something on my other charts where I have all these profiles plotted automatically. This is the TPO profile with my indicators, but basically there's an overlap of the two values. Whenever you get an overlap of the two value areas from the RTH session, from the main session, it can mean a change of sentiment. So again, it's something that we call the bracketing market. The bracketing market, kind of like a range bound market, but for some reason profile traders decided to call that a bracket. But it kind of means a very similar thing, except you're not looking at necessarily just a price action, but you're actually looking at the location and the distance between the value areas for those given sessions. And when they start to overlap, I mean, usually after 3 days of overlapping values, you need to wonder whether that's a distribution of some sort, and we might be looking at liquidation. So all of that is kind of playing on my mind whilst I'm looking at a potential mean reversion upside, because the larger time frame picture kind of doesn't match that. So I might be a little bit careful going longs and maybe a little bit more sizing up going short. I do like to adjust my position sizing slightly, so not massively, but just slightly, in light of how strong or how weak the setup looks, right? So yeah, if we get to COMEX, obviously all of these hypos will be quite different because we might open inside value, and in that case any sort of momentum kind of plays, which is basically what I have here, might be not suitable for that type of day. So yeah, but let's leave these hypos here just for a reminder. Whenever I'm doing these, I have some pretty clear orientation points in my mind. Obviously I use about 3 or 4 different pillars, you know, concepts, cornerstones, if you will, to
definitely for that gap. Missed the move on.
Make me realize what they're trying to do at the best of to the best of my ability. Lexit Music says, I passed mine too. First one since I started. Again, some big milestones here, guys. Excellent. I'm very glad to hear that. It's always nice when I hear that somebody's coaching has led you to a revelation, and then as a coach you get this like warm and fuzzy feeling, but you also get a very iffy feeling when people are not following the rules and not really making any attempt to change their ways. That hurts us, guys. It hurts, like, you know, like that. Why? Because we're trying to help you, right? We've all been there. We know how painful it is to
should have been there
you know, be spinning your wheels, just not really advancing, you know. And then you know, you get into the VIP coaching and you have all these lovely experienced people who are trying to help you out, and you're just like, yeah, whatever. I know better. So, you know, make sure to take action based on what we're trying to teach you here. And literally every single coach here is, maybe we all have different styles, but we're all teaching the same thing. Slow down, size down. Slow down, size down. Slow down, size down. The parrot. I need to get like a parrot puppet. Just to kind of hone the idea into something more physical that I can play with. Bob 3 says, hello D, I'm on my 4th day on my XFA, down 441, now up plus 68 for today. Yeah, Bob, good downside management because you survived for 4 days. How quickly was that minus 441 generated? Was it in a day? Or was it, you know, was it over 3 days? So did you start really slow? Mark Jennifer says, my first time with you. Thank you. Woke up and traded NQ trying to close the gap. Okay, how did that go? I don't really look at NQ much, but I see YM is bleeding. YM is a little bit insane. My choice for this time of day would be DAX, really, but again, we do not have it. We do not have it. DAX is a bit muted compared to YM. Why is YM dropping? that's the question. What is going on with why? Let's see. Some news from the ECB. All right. Russia says Zelensky has categorically refused to make any concessions. Kind of not surprised at that, actually. I don't really see. I mean, yeah, there's some. Okay, but that was yesterday. Russia deal potentially looming. So maybe that's why. But why would it be falling though? It doesn't make no sense. Why the rumor sell the news? I don't know. Cliches, guys. Cliches this morning on the Euro trade. So YM, I don't know. It's just these candles are so massive though. I mean, it's saying 65 ticks. So maybe if we do minis, we have some single prints there. Failed to close the gap. Just continue to go down. limiting risk is a little bit hard. Very hard. Let's plop in YM here. And is NASDAQ following that? Is NASDAQ following that? Yes or no? What is happening? Kind of. Yeah, I would say YM is probably the weakest out of all these. It's got the biggest single prints. So maybe let's formulate a plan. A plan for YM shorts. Let's see. Alright, Bernard, what's going on? Kicking around bottles this early in the morning. I left an empty water bottle on the floor and decided to kick it with his paw. That's my dog, by the way, Bernard, if you're here for the first time. Alright, let's see where the open was. The open was here. Let's put in the marker for the initial balance. Kingdom for TPO profile. But we'll see. So yeah, some single prints left behind. So one of the ways that we might want to wait for this to do something is to maybe wait for a pullback of about 100 ticks here, because the 14 ATR here, actually let's change that to 9, because I think 14 is catching too much of the Asia session. So ATR, where's the ATR? Oh yeah, it's here. Of course. So let's change ATR to 9. Still not that much of a change, 89. So if I get a pullback, somewhere close to the initial balance low, I might do a micro YM trade. Now, YM doesn't have any notable options activity, so that makes things slightly more difficult. But yeah, I would like to see it closer to this former Asia low. And then maybe if there's a continuation, we can jump on that. So yeah, let's monitor these two puppies. And how is that looking on large time frames? Let's just jump through the time frame. So gap close will be happening at 39,363. So you know, a little bit of room there. Not a lot, but still. Weekly chart kind of looking a bit bottomy. Why? Because it's consolidating. Like, we haven't actually exited this area. And still bouncing from that massive monthly previously defined high. Turned support. Demand all the way down at 35.50, 35,500. And what's the 1 hour doing? 30 minutes, so that's not giving me too much info. Let me just put a line to delineate where the gap close, will be.
Bitcoin,
we always go.
Oh, okay, that's what I thought.
The close
like,
of the candle.
Some bullets. So here we go. Well, it's gonna take profit in
Gap
this.
filled.
This is Bitcoin.
But we do have a demand continuous line, as I like to call it. It's basically a point of the market shift.
Back down
kind of consolidated, came up, and then that broke. I have a name for that.
That's what I wanted.
And that's actually slightly lower at 39,214. But yeah, interesting chart. So let's watch it. If we get some buyers after the gap is filled, and in between that 362 and 214,
today.
So this whole area, that could be
beautiful.
Something to plan things around as well. So demand area, there we go.
Yeah.
Just gonna marker here. Okay. Can we look at gold if possible? I mean, Joe, we do have Aaron. I'm finding gold kind of uninteresting at the moment. So let me just save this. It's been a very one-sided market with a lot of spikes.
Sell the pop.
A lot of spikes.
Sell
I
the
mean,
pop.
looking at the larger
And as soon as I say,
what
hey,
do you see?
I'm gonna
This
get
is
into
where
selling this
complicating
pop, this
things
motherfucker's
is
gonna go
not
in
a
opposite
very good
direction.
thing. You know, people are like, oh, maybe we can short gold.
So
Yeah,
good.
you can short
What I'm gonna
gold,
do is I'm gonna
but
take stuff away.
generally every time
Go touch the
the
grass.
gold market sells off, it somehow finds buyers again, and this is not a new thing. Like, we've been doing this for a
I'm gonna
while.
come back, man.
So any sort of a pullback,
I'm not gonna try to buy this thing.
to me, it's a dangerous game to play when the chart looks like this. And
It's
I
in 1
would
minute.
probably more rely on some
30
options
minutes just sliding
activities
down.
to see where the market makers are looking at things. So maybe
you
we
know,
can have a
man.
look at that. Let me just pull out some options.
This is what I do.
Options.
And everything I ain't doing at the very moment.
Jerome is,
And the biggest
my roommate.
contradiction is it ain't none of your business.
What am I looking for? GCM 2025. Let's see. What are the MMs doing? Members, market makers. What are the members doing? And loading. Here we go. Yeah, so we have some calls at 3,300. So if it drops all the way down there, more call buying. Wouldn't be surprised. Don't really have anything much of note around these levels, I'll be honest. It's a little bit iffy. Very weak GEX levels here. Like today, from looking at what they were doing yesterday, we do have some, like a whole bunch of levels sub 3,300. So if we get to like 3,275, it's probably quite likely we're going to see some chop there, because this is going to be hard to break. Very hard to break. But yeah, maybe wait. Like, I wouldn't short down to that point, because we're still very, very strongly above sort of like some statistical areas. I don't know, to me it still just looks very dangerous. I would want to see either a shakeout first and then maybe some more longs, or like some sort of a structure being created somewhere before I get back into gold. Now, keep in mind that I'm talking about gold from a perspective of somebody who looks for very, very large moves intraday. You know, I'm not somebody who's looking for 30 ticks. On even when we don't have sort of quiet, when we don't have volatility and things are a little bit more normal, I would still be looking for at least 70 to 90 ticks, maybe even 100 to 120, provided that obviously the product in question has more than about 250 ticks on average, that it moves pretty much every single day. Now that we have expanded ranges, what tends to happen is that the moves that we're seeing easily give you like 200 to 300 ticks. Easily. It's like 500 ticks as well. Not unusual at all, right? And because of that, I've expanded some of my targets, and I have been running some copper trades up to like 5R multiples. So that has been pretty juicy, you know. It's been pretty nice to
There was a play right there.
you know, to kind
I
of
forgot
just
top
not
step
do
that
that
through.
much work and kind of just keep going.
I just took all my money out of here,
Here's
so I had a
some of
nice
my-
little payout. A little bit.
My numbers on this
I
XFA
love
here,
to play with.
you know, pretty well, not bad.
Yeah.
took a
Yeah, all
payout
about this
from
trade.
that one as well. And
Yeah.
yeah, so it's nice, you know, but I don't look for tiny bits that, you know, I can kind of skim and that's it. I look for decent opportunities that have the power to actually go further, not to like, you know, not to like, you know, be all, ooh, like grab 10 ticks. It's like, no, the market is giving you 300 to 500 ticks potentially, right? Find areas that they can handle big reversals, and areas where, you know, you have like an exhaustion zone, or, you know, you have a big move in the run up to it or run down to it, and then get in. Typically those sorts of trades tend to last for many hours. You know, I like to stay, like, if you look at some of my average, was encouraged by Coach Hoop to show my averages. So let's see if I can somehow do this. So there we go. Can you see that? Am I covering that up? Oops. Hold on. Where's my mouse? What's going on? I need to clean my mouse, I think. So my average trades durations. 82 minutes, 55 minutes. Average trade duration 71. You know, I don't like scalping. You know, why would I scalp when the market is providing me with the opportunity to basically go more? I did have a live account. We decided to start over. I've had the live account since like December 2023, and I made a decision to start that again due to some personal things that are going on. And yeah, so I'm kind of building up. You see, sometimes when you're in the live account, if you've managed to kind of prove yourself, like, it's a bit of a misconception that the top step is like against people going back to XFA. Like, if you have something else going on in your life, if you have, you know, really good, you know, 6 months, and you have over 30 days of winnings, like, you can do things to invest that money elsewhere and start again. Obviously, you have to tell the risk team that, you know, if you're a repeat offender where you keep getting to 30 days of you know, over 200 and then dragging all of it down and then going to the XFA and keep doing it, they don't want that. But, you know,
order
like,
filled.
they want you to do well, and they want you to kind of invest. Like, they don't want you to keep all of that money necessarily all the time in an account. So, you know, whilst it's not good to rinse out things of like, oh, have a live account, 30 days in profit over 200, then drag it down, go back. They don't want that. But every so often, you know, you might
Order
use
filled.
the funds to buy something, you know. So you don't, as long as you're not doing it every month, obviously, they're actually okay with accommodating people. And then also people might be, you know, blowing out of live accounts. That doesn't mean you're going to get banned, especially if you kind of try to hang on and you were okay to trade very small size for a long time. They will just go, well done, you know, you've held on for as long as you could, and yeah, that's it. So
Order filled.
yeah, so let's see what this copper does around this puts. So yeah, a bit of a misconception over how things work on the live level, but it is possible to, you know, with the help of the risk team and stuff, and letting them know what you plan to do and why you need the money. Or, you know, sometimes they will even make a decision to go, hey, you've done really well, like, why don't you maybe drag all of that money down and start again. Like, that's been, like, I know that there were a couple of traders that were, the risk team suggested that because they said something along the lines of, oh yeah, I've just made like
Order
my
filled.
bills for the whole
Order filled.
year in 1 month.
Order
And they
filled.
were like, well, do you want to take this? You know, just cover the bills and come back to the funded level. Like, it's shouldn't be a big deal. So they're not some like ogre company that will keep you They will keep you in shackles if you want to buy something else, you know. People, you know, bash prop firms too much these days. They're very mean. Let's see. What is the best to trade in a 50 account? Micros or minis? Micros, obviously, man. You're working with $2,000 maximum drawdown. Micros. Micros. You have micros. Use them. So yeah, gold to me a little bit of an uninteresting market because it's so temperamental. Was I on YM earlier? Where was I making all my markings? Here, okay. All right, bit of a pullback. Pull it back. So yeah, definitely micros. Let's see. Oh, did I miss some questions? Joe says, have you noticed copper moves very little during the first 3 hours of COMEX, then trends after? Is that something to do with your close? Yes, Joe, you're very right. There is recently a little bit of a quieter period, so you have the initial decision of which way we're gonna go, and then you have something called the post-end
order filled.
Typically,
Order
some
filled.
of the other products, like including GC, but also copper and crude oil, actually can bring complete reversals of the trend for the day. Now in copper, because it's so directional, it tends to be more of a momentary retrace before it kind of continues about 90 minutes later. So if you're looking to get involved in
order
copper
filled
around the euro close, the better. So first of all, that's going to be a smaller trade. It's not going to be like a gazillion ticks that I like to take, but it's going to be decent enough to
order
maybe
filled
grab like 40 ticks out of it, 40 to 50 ticks on a pullback. And then once that happens, you can maybe have a look at more shorts after the euro close into the lunchtime, and then certainly into COMEX settlement, which happens my time is like 6:30 p.m. That will be, I believe that's 12:30 p.m. Central. I think it's 12:30 p.m. Central, yeah. Oh, I need to wake up. Okay, so more caffeine. Mark says up 9.9k today shorting ES. Brilliant work. Keep that money, mate. Davey says I don't use a dome. I opened though yesterday and removed it. What should I do? Don't know what that's. I missed something. Did I miss something? Did I miss something? Yeah, Zed Gomez is correct, because if you take it out, they get funds too. Correct. Yeah, so if it's a live account, it comes from the live market, right? But it's not to say that you will never be in an XFA. But if you abuse the rules, obviously, somebody coming in, generating 30 days of 200 in a live, then withdrawing it, and then going back and then keep doing it, yeah, they're going to be like, well, what the hell, man? Stop being a sim farmer and let's do some real trading. Once you are live, you're not supposed to take out the money too often. But yes, if you do have something and you want to spend it too, just talk to the risk team and go, hey guys, this is what's happening. Or if you're struggling as well, they're like really, really good. Bruno, yes, go get another coffee. I can be all alone for 5 minutes. just joking. Go get another coffee. So yeah, let's see. YM creeping up to 39,500. Mo says, the thing I noticed from all of the coaches like yourself is the conviction in your thoughts process and how calm you all are, regardless of how trades are playing out. I think that just comes with time, to be honest. I know that Mike Koza also said, yeah, I want to be calm as you in a trade. And sometimes people think, oh, you're monks, you're not, even if the trade is in drawdown, people are not freaking out, because we've seen it before, and I think mostly it's because our losses are rather controlled on most days. yeah, sure, we can have a bad day, but there's a limit to the bad day, I think, for most of us who have been around for a while. And yeah, I think the amount of cash that you're risking per trade in relation to the account balance is probably the reason for staying calm or staying, you know, staying unbothered in a trade, I guess. And it doesn't matter whether it's, you know, whether I'm making, because I have different sized accounts, right? Obviously, I have some personal accounts and I have new accounts, right? To me, it's exquisitely important that every time I'm in a trade, that I have a measurable thing of how the trade is doing, irrespective of the position size. And this is why you see me trade in ticks. I don't trade in P&L. You know, you can look at the P&L, and in fact, a lot of the times I have my balance blocked out completely, and I only look at it at the end of the week. So that allows me to completely focus just on the process. And no matter whether you're trading like 80 lots or, you know, 1 micro, a tick is a tick. You know, maybe execution might be different once you get to a certain size. If you ever get to a size, maybe you even need to worry about that. Because let's face it, most traders who are doing exquisitely well as traders basically trade 3 and 4 lots. Like, you know, 3 to 4 minis can bring you quite easily, you know, 5-6K a day. That's like over $1 million a year, right? So anything over that, it's usually because it's either a corporate account or maybe it's a large prop account, or, you know, maybe you're sharing that account.
Order filled.
That's corporate with multiple people, so obviously more profits need to be generated and things like that. But if you are constantly focusing on
Order
P&L,
filled.
you will never really get to the point where you're like, oh, I'm just totally chill because this trade is the same that I do on 1 micro, except it's a bigger size. But it doesn't look any different to me when I'm looking at ticks. So yeah, but I also think that the replacement of certain negative behaviors that we've all had to do, you know, are you really a trader? If you haven't made a lot of mistakes and hugged yourself in a corner crying your eyes out at some point. You know, it is a difficult industry to be in.
Order
if
filled.
you are particularly emotional. Now, I was never super emotional by nature. Like maybe when I was a kid, you know, maybe when I was like 3 years
Order
old.
filled.
I think that's the case for most people. But then life happens and your threshold for what should elicit emotional reaction kind of starts getting higher and higher. Then you get into trading and that sort of skyrockets, where you just realize, you know, you have those memes. It's like, you can't hurt me, I'm a day trader and I trade NQ, right? There's a good reason for it. There is nothing that can traumatize you more than you making mistakes yourself and derailing your standard of living through your actions. It's like absolutely terrifying, right?
Order filled.
But after a certain time, you're just like, okay, so let's not size up like lunatics. Let's not rush. I actually have a tattoo on my forearm.
Order
that
filled.
Says that haste makes waste. And I've lived by that, not just in trading, but in everything that I do. You know, you rush, you create rubbish. You take it slow, you kind of develop skills and an identity shift to be able to reach even bigger goals. And it's not a linear process. You know, you do go up and down.
Order
especially in
filled.
trading.
Order
you can run
filled.
into
Order
market
filled.
conditions that are just not very good for your strategy. That can happen too. And as traders, you have to just weather those. You can't just go, oh, boo-hoo, market is mean to me. You have to just go, all right, so that's not working. What else is working? So that kind of an adaptive nature of every single coach that you see here, and just sheer, I suppose, sheer resilience and sheer refusal to give up in the face of adversity. I think every single coach here has that as a trait. And I think we're just naturally like that. Like, you have to be born like that. Maybe you can develop it as well, but you know, I popped into like Top Step TV lobby Top Step Lobby on Discord, and I was just kind of reading through different messages and stuff. Few mean comments here and there. People think that we don't read those, but we do. We see everything.
Order
And
filled.
then I saw, someone saying, "Oh, I've tried this for 4 to 5 years. This is not for me. I'm finding a real job." And to me, I'm saddened to hear that, because it means that that particular person probably wasn't put on the right path immediately, and therefore they think
Order
going
filled.
back to the safety and going back to the norms is the right thing. Now, I'm not saying that it isn't, because not everybody can be a trader. That is a very big truth. Not everyone is good with uncertainty, and maybe some people can never get over their self-limiting beliefs that they reach a point where they trust themselves, because let's face it, most of you don't trust yourselves to make good decisions. So that's a self-limiting belief that needs to be tackled. It's exactly why we have the Neuro Wednesdays with Jerome. We're trying to replace some of those bad ideas that we have about ourselves that were created very, very early on, and then we're trying to replace them with something positive, right? And it's a lot of self-work. It's not easy. A lot of self-work. But yeah, I think that the calmness in positions that you see just comes from the confidence of having seen the same setup. And I mean, if you know anything about me, I'm pretty bloody systematic with coming up with setups, right? To the point that I mechanically know what they look like through a flow diagram or a mind map. I'm pretty sure I've shown some of these before. But yeah, this is how I define setups. It's just like one of many. Something that I was trying to make sure I don't get involved in a trade that isn't absolutely spot on. And I usually like to have about 3 conditions for my star setups. So here's one, here's a second one, here's a third one. Anything else is price action related, like whether we have some levels that could support the idea, supportive factors and all of that. I'm actually doing a lecture on timing trades and making yourself more systematic and defining your setups for my VIPs probably tomorrow. So I'm going to try and do like the Friday roundup, and then we're going to do a lecture as a part of that. But yeah, if you don't even know what your setup looks like, I would urge you to
Order filled.
do something like this, to create a flow diagram and to just go, what did I actually do? Now this requires experimentation. You can't just go, I think it's going to go this way. Like, you can absolutely start with an observation that, for example, initial balance low, whenever you have the extension down and you're quite far away from VWAP and you have this big sloping VWAP curve, that can bring further downside, right? And you can just observe without trading what's going to happen at initial balance low. There are a couple of options. Now, whatever happens, you put that in your journal, right? And you write down things like, how did we look like? Let's say that I'm wrong on the initial balance low continuation, and we accept value. So we accept initial balance and go into
Order filled,
because that's what the failed auction is. Now, some of the things that I like to do in my journal, if I'm figuring out a new setup or a variation on a setup, I will be going, how did we fail the value? Was there anything that gave me
order filled,
clues that the failed auction is more likely than the continuation? And then you go, well,
order
30-minute
filled,
chart showed a 3-bar reversal, and then it failed the auction. If it ends up as a 3-bar reversal, this will be a morning star. What do we have on the 15-minute chart? Well, we had a bit of an inside candle here, so like more of a consolidation. Not
order
the strongest, not the strongest. Usually, if the failed auctions come
order
true,
filled,
they tend to happen via 15-minute bullish engulfings that are much closer to the initial balance. And then, what's the 9 EMA doing? Right now, it's matching
order filled,
the initial balance low on the 15 minutes. So Can we maybe get a bounce from there, or are we going to see the price pick up strength, maybe pick up volume as well, which is not happening yet. We actually have less volume on this second candle, and then see what happened after. So that's your starting point, observation mode. Once you have gathered enough trades, like let's say you've seen about 20-30 trades of either a failed auction or a continuation, now you have a little sample size to work from, and then you go, well, let me try on 1 micro to see whether the same thing plays out and how I feel in this trade. Do I feel anxious? Am
Order
I reading
filled.
it objectively? What did the trade look like when it failed? What did it look like when it continued? Which of the two of these options, today's price action as I'm observing it, looks the most similar? And then you slowly kind of build confidence around your setups. It's a slow process, and nobody can really do it for you. You can't teach people to swim without actually getting in the pool. Trading is kind of the same thing. You can read all the books and watch all the YouTube videos on swimming.
Order
and
filled.
do the motions, but it's not quite the same
Order
as
filled.
getting in the water and going, whoa, this is a bit different. Ayush says I'm up 200% to get another account. Yeah, that's a bad thing, Ayush. Easy come, easy go, mate. Slow down. Slow down, size down, slow down. Really need to get that parrot puppet. Maybe I should commission Eddie to make me one. Slow down, slow down. Slow down, slide down, slow down, slide down. Has anyone ever noticed slowness in Top Step? No. But go and try to change your refresh rate. That might help. Don't go too crazy. Especially if you're not on some super high ultra fast broadband, but yeah, try adjusting your refresh rate. Speed at which data updates is what the refresh rate stands for. IT support, D, reporting. Good duty. Paul H says good morning, listening whilst watering my bonsai trees. Very zen, Paul, very zen. Getting centered for the day ahead. Yeah. Coach, can you explain the 20% consistency? 20% consistency does not exist. 50% consistency does exist. It's literally this. If you have a target of 3K in a combine, you cannot have any single day that goes over 50%.
Order filled.
Okay.
Order filled. Order rejected.
So if you overshoot, you're gonna have to, it's not gonna fail the combine, but you're gonna have to trade more. Completely pointless in a combine. Reserve the YOLOing big days. Like, look, if it's your style, if it's like swing trading and you just enter 3 micro and quarter massive move, that's okay. But if you traded like 1 to 2 and 3 minis, I actually had someone in the VIP who had a bit of a weird idea of what low lots means. They were saying, oh yeah, I was trading on a practice account, which, is wrong in the first place. And then I was, I made so much cash and I was trading low lots too. And we're like, what do you mean by low lots? And he goes, oh, it was just like 2-3 micro, 2-3 minis on NQ. Think that 3 NQ lots is low lots in this environment. Okay. And a lot of my VIP members were like, dude, that's not low lots. It's like, and people were a bit shocked at the statement. So yeah, it depends how you got there. If you got it through catching a big swing, that's fine. On low lots, like 2 and 3 micros. But if you did it trading a mini and you're up 200%, that ain't gonna last, man. I'm just quoting statistics and what I've been seeing through the 3 months of VIP. I started the VIP coaching assuming competence. I think in the next season that's gonna change. So, and we're kind of changing how we're running the coaching as well. Right, let's drop down to 2-minute chart and see. Maybe 100 tick. Maybe 100 tick. There's not, ain't low enough, mate. So I'm on a 2-minute chart with the marker for the initial balance. I'm watching how YM is behaving, and we are going to, yeah, copper bloody slow. Look at
Order
it.
filled.
Not doing anything. So let's see if we can get some action in YM. I'm going to keep an eye on copper whenever it decides to, whenever somebody kicks it up the bum.
Order filled.
And it's like, oh, we need to
Order
move. But
filled.
yeah, I do think the rollover is slowing it down quite a bit. So we need to be a bit mindful. Now, I need to use a decently sized stop loss. We have basically 100 points on a 30-minute candle. And I also see that YM has like masses and oodles of ticks per day. Even London is like 375 average, and that's a shortened London session up to the New York Stock Exchange open. Let me try not crouch. New York has 871 ticks available. It's massive, so we can't be skimping on stops. So low size, wider stops to give the trade room to breathe. But so far not really seeing much initiation of the shorts yet. So we wait. Copper is at IB high. Yeah, copper pumped at IB high, just slightly, but the IB is 32 ticks today. It's so small that it increases the odds of a neutral day massively. You can either have a massive trending day, but only if they initiate pretty early in the day. If they don't, you're looking at a slow start to the day. So that's why I'm not in any rush to trade today.
With me getting off into, sticking to my goals and everything, right? I'm gonna have to trade something that is not moving like it's been moving, and something that I kind of know. I forgot all about my Euro USD trade. I think
Order
I might
filled.
just gotta see how it works. Let's see how it works. Excuse me. Do like a 15 lot ordeal.
Order filled.
$75 loss there, so I'll bring it up to $50 loss. I have to get in. I'm just clicking buttons right now. I'm not looking at any chart. Yes, of course, I'm buying the top of this thing. Hoping that it breaks out of here. Of course, it's probably a sell-off, but just want to make sure this $56 is $56. If that's the case, I could be out of this already, right? I could probably play this off of 1 minute, don't like nothing, right? I'm gonna do that, huh? I don't like that. This has to be on like a tick or something. I can't remember this, so I'm not gonna use it. I will see what the 30-second looks like. Nope, not gonna play with that. Nope. Chart just looks a little bit different. right to sit here on the 15-minute chart. Go ahead and go out like that. I have to catch a breakout. Oh, I had to catch a breakout. Just to get the profit. Let's see. This thing just moved up and down.
Order filled.
I don't know how I'm gonna do this.
My screen. Yeah, so we have Euro FX 625 again. 13 years ago when I went into futures, that was like 1250. But yeah, pound is also now cheap. Don't see it here. You have Canadian futures. I don't know whether they cut those as well. So I'm gonna have to do a little bit of digging just to get myself up to speed over what Forex futures have done. But yeah, it just shows you how much I trade those. Yeah, don't even know the tick size. Let's see, more questions while we
Order
wait.
filled.
Alright, we're sort of struggling a little bit here, so just still watching this while I am. I'm waiting for my setup.
So I'll probably
did
do the
that
size
one.
down to 10.
Ayush says, what do you mean by slowing down? Well, let's put it this way. If you put in
Like that, I can get
50
out.
grand's worth, let's kick up the size, shall we? If you put in $50,000 of your actual real money into a real brokerage account, and on the first day or first week, you actually make $100,000 that same day or that same week. How much size would you need to be trading to generate that? Quite a lot, okay? So that tells me the returns of 200 over a very, very small, quick period of time, it means you're oversized. I don't even have to look at what you were doing, right? So it's not just trading less, but definitely trading less size. Why? Because I don't know how much you trade, whether you're a scalper or wannabe scalper, or whether you're more swing trader, what I do. But yeah, if you're scalping and with size and you're doing, full contracts, that's a recipe for disaster. Like I always talk about my risk of ruin video that I did on my YouTube channel, I think about a year or so ago. And you can find it, you can find my YouTube channel link underneath this video. They've kindly put it there. Yeah, find risk of ruin video where I talk about why, things like over trading, sizing up. Like the more you trade intraday,
I mean, I guess it's true, but like it's like
Order
a
filled.
down
suspicious accuracy as well. You can get a day where you get really lucky, but you can also get a day where you derail the account completely. So if you start thinking in bigger terms, in like much bigger sizes, is it sensible to make 100,000 on a 50,000 pound pot or dollars?
So what I'm gonna
in a
do
day
is
or in a week.
shut that down. I don't know why, but it rubbed me the wrong way. I don't like didn't like it. I don't even know when. Yeah, I am live. Yeah. What the fuck is this dude working at?
Views and opinions expressed in this book belong to the author and may not necessarily reflect the Science is dedicated to the author of all science, to his glory and for the good of humanity by his light bearer. Introduction. Let those who read this book understand that its main object is to bring enlightenment to humanity through pure knowledge aflame with love, and its mission is to pave the way to peace and harmony and power. Though a book of science, it is a friend of true religions and philosophies. They will find their fundamental tenets scientifically explained by the science of being, which will also show them that they are brothers, because truth is one and is the golden thread on which are strung the very pearls of religions and philosophies. The day will come when humanity will have outgrown its present concepts of divinity, when man will have lost his faith in teachings based on faith alone, the day when utter despair will grip the heart of a world which has lost its God. Humanity will then discover through the science this book teaches that God has always lived with men, yet they have not known him. The author. First day, Lesson 1. The Absolute, Spirit, the 5 aspects of the great principle. The fall, the beginning of involution. Like a star falling from heaven did he fall to earth. Creation. Let there be light, the earth as flaming nebula. Element, fire. Involution through fire. Color, gold and orange. I am one. Unity is the law of the absolute. Lesson 1, the absolute, spirit. Great question. The greatest of all questions has been asked by humanity for countless ages. Is there a God? From the point of view of religion, it is accepted on faith that there is a God, a divinity, who is called the Father of man and of the universe. But human beings are not satisfied with believing on faith. They want to know, to have irrefutable proofs of the existence of divinity. Therefore, has it become the task of science to investigate the matter and find an answer to this question, an answer which will satisfy the searching of the rational mind, and science has solved the problem nobly. Through scientific investigation, it was discovered that there is a universal force which may be termed eternal energy, primal energy, pervading the whole universe, filling infinite space. If primal energy fills infinite space for one moment, it becomes at that moment one with space. And if it is one with space for one moment, it must be one with space for eternity, because there is no place where it can lose itself. Therefore, by logical reasoning, the basic energy of the universe is found to be infinite, and at the same time eternal, has always been and always will be so. Through further investigation, it was discovered that infinite energy expresses itself in most admirable laws, sublime laws, that it shows the profoundest intelligence and logic, a self-consciousness expressed in the divinest terms, laws invariable, true to themselves, mathematically correct, and above all, harmonious and beautiful. As a result of all this reasoning, was discovered through its first universal manifestation as primal energy, that which has always existed, the eternal, unmanifest called God, conscious of its own power, law-emitting, law-abiding, and most harmonious. In other words, there is a unit, a one, existing eternally, expressing itself through its creation, the universe, consciously governing it, sustaining it in a condition of eternal harmony and loving it. For harmony and love are one. Harmony means attraction. Love is attraction. Thus, science has discovered divinity under another name. Therefore, for the word God, which would have been used in religion or philosophy, will be substituted, a word having a deeper meaning, covering broader ground, the word principle. The word principle is not related especially to divinity, but applies equally to every science, logic, activity, and art, as the principle of music, the principle of mathematics, etc. The word principle gives a clearer idea of the great first cause of divinity than does the word God. The word itself cannot be exhausted by its various definitions, and if instead of a few definitions we should give 10,000, the whole ground would not have been covered. Yet there are 5 words which characterize the word principle in general, including principle as applied to the great first cause, divinity, the great principle. Scientific definition of the word principle. Principle is that which creates, constitutes, governs, sustains, and contains all. These 5 words include all the various lesser definitions. What must principle do first? First, it must create, because it cannot handle anything before it has created the very thing it has to handle. Thus, the first activity of each principle, no matter if it is the principle of music or of mathematics or of anything else, must be creation. The principle of music creates notes. The principle of mathematics creates numbers, etc. But creation does not inevitably mean order. It may be chaos. So that there should be order, it must constitute, that is, assign to each phenomenon its proper place, which it will keep eternally. With numbers, the activity of constitution demands that 1 is made 1, 2 is made 2, 3 is made 3, etc., and each has its proper place. 2 can never lapse into 3, or 3 can never become 4. They are all immutable. It is only because they are what they are, eternally, immutably, that we can calculate at all mathematically. The most complicated, intricate calculations are possible only because each cipher has its place assigned, constituted in order out of chaos. What is the next activity of principle? It must bring forth out of itself its laws, changeless laws, by which it governs that which it has created and that which it has put in order, constituted. These laws are then named. There are, for example, the laws of mathematics. Through the application of these laws, we attain the invariable result of our calculations. If we misapply the laws, we make mistakes. This applies equally to music, to logic, etc. But the acts of creation, constitution, and governing may be for but a moment. There is nothing in these 3 activities which ensures their continuance. After principle has created, constituted, and governed, it must sustain its very creation so as to make it permanent, eternal. And finally, if principle creates everything there is out of itself, it must then contain within itself all its creation. It must be the father of its creation. It must be the circumference from within which springs all creation. And since principle from its own center creates all and becomes its own circumference, therefore it is the center and circumference of all.
Order filled.
Principle is all. So it is with the great principle, the great first cause, whom we call divinity or God. From eternity out of itself, the great principle created the universe, including man and everything else in the universe. From eternity, it assigned to each created thing its proper place. Every blade of grass has its place. Every star knows its course. And as long as all keep their places and perform their duties, the law of order in the universe continues to operate. But if they should slip from their places or fail in their duties, there is chaos. The law of order and harmony is transgressed. After it has assigned to everything its proper identity, its individuality, it issues from itself the universal, changeless laws, which then govern them. Everything down to the smallest electron is governed by its laws. Laws are precise, as invariable, as mathematical as the laws of mathematics itself, for mathematics is part of its creation and is therefore subject to its laws. Nothing can be above or beyond these laws, for they are a manifestation of the eternal activity of the great principle itself. The fourth activity of the great principle is its power to sustain. It pours out all life and energy from itself and sanctions and supports its own life, intelligence, laws, and love so that they will exist with it eternally. From it proceeds all. And lastly, as the mother bird covers her fledglings with her wings, so the great principle enfolds all creation within its boundless protection and love. It contains the whole universe, and therefore may be said to be in a way greater than its own creation. Yet it is identical with creation, for creation is the exact counterpart of the great principle, the eternal unmanifest, of which we perceive but the manifestation. No one has seen the great principle, the unmanifest, at any time. We perceive and appreciate it only through its manifest laws. The universe is the manifestation and the scientific actual proof of the existence of the great principle. To this present state of human consciousness, the great principle appears in four distinct aspects: life, mind, truth, love. They are in a certain scientific order. They have been so eternally and cannot be changed. It has been said God is first love. But one cannot love if one does not already live, and even divinity itself cannot reverse such a sequence. The great principle is first life. It must first live, and then it can think. It must first live, and then it can express truth, law. It must first live, and then it can love. The first aspect of the great principle, therefore, is life. What comes next? Mind. For life must become conscious of itself, conscious of its own existence. If it were not conscious of itself, life might be said not to exist completely, but it is able to say, I think, therefore I am. Next must come truth, law. The self-conscious life must be true to itself eternally, law-emitting, law-abiding, since it can only work harmoniously when it is true to itself. And finally, what must be last? It must be love, harmony. For if life were not capable of love, of harmony, it would be set against itself, repelling instead of attracting, self-hating, and therefore self-destructive. Love and harmony are synonymous terms. Love is the law and also the fulfilling of the law. It is love alone that sets the seal of eternity on all. It is love alone that justifies eternity and makes it what it should be, a blessing. Without love, eternity would be the most terrible hell imaginable, for it is only when we know that there will be everlasting harmony that we can face eternity. And the only guarantee of eternal harmony lies in the fact that the great principle itself must love eternally in order to maintain throughout eternity its own existence. That is why we cling to love to the very last, when all else, life and mind, and even truth, have apparently failed us. Love is not first in order, but in importance. Whatever else may be achieved will be of no use without love, for it is the beauty and radiance and joy of the universe. These are the four aspects of the great principle. They are instantaneous and simultaneous, yet expressed in their logical order. This order cannot be changed. It is fundamental and scientific. Those four aspects of the great principle, as manifested in our lives, may be regarded as the four corners of a perfect square, and their mutual relations analyzed from a scientific point of view. Let us take the upper left corner, life. What does life face if we pass a line across the square diagonally? We find life facing truth. What does this mean? It means that the first eternal duty of life is to be lived, that it must be true to itself. For if life is not expressed through activity, there is no hope possible for it. In order that there should be continued activity, energy manifested, thus making all else possible, life must be true to its own mission, to live. For this reason, it faces truth. What has life on its right side? It has mind. The right side is always considered the dominant side because it stands for the right. Therefore, life has mind on its right side. This implies that life must be conscious of its own existence, of its own operations, of its own duties, for if it were not self-conscious, it could not achieve all that it should achieve. Upon the left side, life has love. This means that life must not only be constantly active, conscious of itself and its activities, but that in order to be eternal, it must also be alive.
An amateur looks at a quote screen and sees millions of dollars sparkle in front of his face. He reaches for the money and loses. He reaches again and loses more. Traders lose because the game is hard, or out of ignorance, or lack of discipline. If any of these ail you, I wrote this book for you. In the summer of 1976, I drove from New York to California. I threw a few books on psychiatry. I was a first-year psychiatric resident. Several histories, and a paperback copy of Engels' How to Buy Stocks into the trunk of my old Dodge. Little did I know that a dog-eared paperback, borrowed from a lawyer friend, would in due time change the course of my life. That friend, incidentally, had a perfect reverse golden touch. Any investment he touched went underwater. But that's another story. I gulped down the Engel book in campgrounds across America, finishing it on a Pacific beach in La Jolla. I had known nothing about the stock market, and the idea of making money by thinking gripped me. I had grown up in the Soviet Union, in the days when it was, in the words of a former U.S. president, an evil empire. I hated the Soviet system and wanted to get out. But emigration was forbidden. I entered college at 16, graduated medical school at 22, completed my residency, and then took a job as a ship's doctor. Now I could break free. I jumped the Soviet ship in Abidjan, Ivory Coast. I ran to the U.S. Embassy through the clogged, dusty streets of an African port city, chased by my ex-crewmates. The bureaucrats at the embassy fumbled and almost handed me back to the Soviets. I resisted, and they put me in a safe house and then on a plane to New York. I landed at Kennedy Airport in February 1974, arriving from Africa with summer clothes on my back and $25 in my pocket. I spoke some English, but did not know a soul in this country. I had no idea what stocks, bonds, futures, or options were, and sometimes got a queasy feeling just from looking at the American dollar bills in my wallet. In the old country, a handful of them could buy you 3 years in Siberia. Reading How to Buy Stocks opened a whole new world for me. Returning to New York, I bought my first stock. It was KinderCare. Ever since then, I have avidly studied the markets and invested and traded stocks, options, and now mostly futures. My professional career proceeded on a separate track. I completed a residency in psychiatry at a major university hospital, studied at the New York Psychoanalytic Institute, and served as book editor for the largest psychiatric newspaper in the United States. These days, I am busy trading and go to my psychiatric office across the street from Carnegie Hall only a few afternoons a week after the markets close. I love practicing psychiatry, but I spend most of my time in the markets. Learning to trade has been a long journey, with soaring highs and aching lows. In moving forward or in circles, I repeatedly knocked my face against the wall and ran my trading account into the ground. Each time I returned to a hospital job, put a stake together, read, thought, did more testing, and then started trading again. My trading slowly improved, but the breakthrough came when I realized that the key to winning was inside my head and not inside a computer. Psychiatry gave me the insight into trading that I will share with you. Psychology is the key. You may base your trades on fundamental or technical analysis. You may trade because of hunches about economic or political trends, use inside information, or simply hope. Remember how you felt the last time you placed an order? Were you anxious to jump in or afraid of losing? Did you procrastinate before picking up the phone? When you closed out a trade, did you feel elated or humiliated? The feelings of thousands of traders merge into huge psychological tides that move the markets. The majority of traders spend most of their time looking for good trades. Once they enter a trade, they lose control and either squirm from pain or grin from pleasure. They ride an emotional roller coaster and miss the essential element of winning, the management of their emotions. Their inability to manage themselves leads to poor money management of their accounts. If your mind is not in gear with the markets, or if you ignore changes in mass psychology of crowds, then you have no chance of making money trading. All winning professionals know the enormous importance of psychology in trading. All losing amateurs ignore it. Friends and clients who know that I am a psychiatrist often ask me whether this helps me as a trader. Good psychiatry and good trading have one important principle in common. Both focus on reality, on seeing the world the way it is. To live a healthy life, you have to live with your eyes open. To be a good trader, you need to trade with your eyes open, recognize real trends and turns, and not waste time or energy on regrets and wishful thinking. Why do most traders lose and wash out of the markets? Emotional and thoughtless trading are two reasons, but there is another. Markets are actually set up so that most traders must lose money. The trading industry kills traders with commissions and slippage. Most amateurs cannot believe this, just as medieval peasants could not believe that tiny invisible germs could kill them. If you ignore slippage and deal with a broker who charges high commissions, you are acting like a peasant who drinks from a communal pool during a cholera epidemic. You pay commissions for entering and exiting trades. Slippage is the difference between the price at which you place your order and the price at which it gets filled. When you place a limit order, it is filled at your price or not at all. When you feel eager to enter or exit the market and give a market order, it is often filled at a worse price than prevailed when you placed it. The trading industry keeps draining huge amounts of money from the markets. Exchanges, regulators, brokers, and advisors live off the markets while generations of traders keep washing out. Markets need a fresh supply of losers, just as builders of the ancient pyramids of Egypt needed a fresh supply of slaves. Losers bring money into the markets, which is necessary for the prosperity of the trading industry. Brokers, exchanges, and advisors run marketing campaigns to attract more losers to the markets. Some mention that futures trading is a zero-sum game. They count on the fact that most people feel smarter than average and expect to win in a zero-sum game. Winners in a zero-sum game make as much as losers lose. If you and I bet $10 on the direction of the next 100-point move in the Dow, one of us will collect $10 and the other will lose $10. The person who is smarter should win this game over a period of time. People buy the trading industry's propaganda about the zero-sum game, take the bait, and open trading accounts. They do not realize that trading is a minus-sum game. Winners receive less than what losers lose because the industry drains money from the market. For example, roulette in a casino is a minus-sum game because the casino sweeps away 3% to 6% of all bets. This makes roulette unwinnable in the long run. You and I can get into a minus-sum game if we make the same $10 bet on the next 100-point move in the Dow, but deal through brokers. When we settle, the loser is out $13, and the winner collects only $7, while two brokers smile all the way to the bank. Commissions and slippage are to traders what death and taxes are to all of us. They take some fun out of life and ultimately bring it to an end. A trader must support his broker and the machinery of exchanges before he collects a dime. Being simply better than average is not good enough. You have to be head and shoulders above the crowd to win a minus-sum game. You can expect to pay a round-trip commission of anywhere from $12 to $100 for every futures contract you trade. Big traders who deal with discount houses pay less. Small traders who deal with full-service brokers pay more. Amateurs ignore commissions while dreaming of fat profits. Brokers argue that commissions are tiny relative to the value of underlying contracts. To understand the role of commissions, you need to compare them to your margin, not to the value of the contract. For example, you may pay $30 to trade a single contract of corn, 5,000 bushels worth approximately $10,000. A broker will say that the $30 commission is less than 1% of contract value. In reality, you have to deposit about $600 to trade a contract of corn. A $30 commission represents 5% of margin. This means you have to make 5% on the capital committed to the trade simply to break even. If you trade corn 4 times a year, you will have to make a 20% annual profit to avoid losing money. Very few people can do this. Many money managers would give their eye teeth for 20% annual returns. A small commission is not a nuisance. It is a major barrier to success. Many amateurs generate 50% and more of their account size in commissions per year, if they last that long. Even discounted commissions raise a tall barrier to successful trading. I have heard brokers chuckle as they gossiped about clients who beat their brains out just to stay even with the game. Shop for the lowest possible commissions. Do not be shy about bargaining for lower rates. I have heard many brokers complain about a shortage of customers, but not many customers complain about the shortage of brokers. Tell your broker it is in his best interest to charge you low commissions because you will survive and remain a client for a long time. Design a trading system that will trade less often. Slippage takes either piranha-sized or shark-sized bites out of your account whenever you enter and exit the markets. Slippage means having your orders filled at a different price than that which existed when you placed an order. It is like paying 30 cents for an apple in a grocery store, even though the posted price is 29 cents. There are 3 kinds of slippage: common, volatility-based, and criminal. Common slippage is due to a spread between buying and selling prices. Floor traders maintain 2 prices in the market, the bid and the ask. For example, your broker may quote you 390.45 for June S&P 500. If you want to buy a contract at the market, you'll have to pay at least 390.50. If you want to sell at the market, you will receive 390.40 or less. Since each point is worth $5, the 10-point spread between bid and ask transfers $50 from your pocket to floor traders. They charge you for the privilege of entering or exiting a trade. The spread between bid and ask is legal. It tends to be narrow in big liquid markets such as the S&P 500 and bonds, and much wider in thinly traded markets such as orange juice and cocoa. The exchanges claim that the spread is the price you pay for liquidity, being able to trade whenever you wish. Electronic trading promises to cut slippage. Slippage rises with market volatility. Floor traders can get away with more in fast-moving markets. When the market begins to run, slippage goes through the roof. When the S&P 500 rallies or drops, you can get hit with a 20 to 30 point slippage and sometimes 100 points or more. The third kind of slippage is caused by criminal activities of floor traders. They have many ways of stealing money from customers. Some put their bad trades into your account and keep good trades for themselves. This kind of activity and other criminal games were recently described in a book, Brokers, Bagmen, and Moles, by David Greising and Laurie Morse. When 100 men spend day after day standing shoulder to shoulder in a small pit, they develop a camaraderie, an us-against-them mentality. Floor traders have a nickname for outsiders which shows that they consider us less than human. They call us paper, as in, is paper coming in today? That is why you have to take steps to protect yourself. To reduce slippage, trade liquid markets and avoid thin and fast-moving markets. Go long or short when the market is quiet. Use limit orders. Buy or sell at a specified price. Keep a record of prices at the time when you placed your order and have your broker fight the floor on your behalf when necessary. Slippage and commissions make trading similar to swimming in a shark-infested lagoon. Let us compare an example from a broker's sales pitch to what happens in the real world. The party line goes like this. A contract of gold futures covers 100 ounces of gold. 5 individuals buy a contract each from someone who sells 5 contracts short. Gold falls $4, and the buyers bail out, losing $4 per ounce or $400 per contract. The intelligent trader, who sold 5 contracts short, covers his position and makes $400 per contract for a total of $2,000. In the real world, however, each loser has lost more than $400. He paid at least a $25 round-trip commission and was probably hit with $20 slippage coming and going. As a result, each loser lost $465 per contract, and as a group, they lost $2,325. The winner, who sold 5 contracts short, probably paid a $15 round-trip commission and was hit with $10 slippage coming and going, reducing his gain by $35 per contract or $175 for 5 contracts. He pocketed only $1,825. The winner thought he made $2,000, but he received only $1,825. The losers thought they lost $2,000, but in fact they lost $2,325. In total, fully $500, $2,325 minus $1,825, was siphoned from the table. The lion's share was pocketed by floor traders and brokers who took a much bigger cut than any casino or a racetrack would dare. Other expenses also drain traders' money. The cost of computers and data, fees for advisory services and books, including the one you are reading now, all come out of your trading funds. Look for a broker with the cheapest commissions and watch him like a hawk. Design a trading system that gives signals relatively infrequently and allows you to enter markets during quiet times. Individual psychology. Trading appears deceptively easy. When a beginner wins, he feels brilliant and invincible. Then he takes wild risks and loses everything. People trade for many reasons, some rational and many irrational. Trading offers an opportunity to make a lot of money in a hurry. Money symbolizes freedom to many people, even though they often do not know what to do with their freedom. If you know how to trade, you can make your own hours, live and work wherever you please, and never answer to a boss. Trading is a fascinating intellectual pursuit. Chess, poker, and a crossword rolled into one. Trading attracts people who love puzzles and brain teasers. Trading attracts risk takers and repels those who avoid risk. An average person gets up in the morning, goes to work, has a lunch break, returns home, has a beer and dinner, watches TV, and goes to sleep. If he makes a few extra dollars, he puts them into a savings account. A trader keeps odd hours and puts his capital at risk. Many traders are loners who abandon the certainty of the present and take a leap into the unknown. Most people have an innate drive to achieve their personal best, to develop their abilities to the fullest. This drive, along with the pleasure of the game and the lure of money, propels traders to challenge the markets. Good traders tend to be hardworking and shrewd. They are open to new ideas. The goal of a good trader, paradoxically, is not to make money. His goal is to trade well. If he trades right, money follows almost as an afterthought. Successful traders keep honing their skills. Trying to reach their personal best is more important to them than making money. A successful New York trader said to me, "If I become 0.5% smarter each year, I'll be a genius by the time I die." His drive to improve himself is the hallmark of a successful trader. A professional trader from Texas invited me to his office and said, "If you sit across the table from me while I day trade, you won't be able to tell whether I am $2,000 ahead or $2,000 behind on that day." He has risen to a level where winning does not elate him and losing does not deflate him. He is so focused on trading right and improving his skills that money no longer influences his emotions. The trouble with self-fulfillment is that many people have a self-destructive streak. Accident-prone drivers keep destroying their cars, and self-destructive traders keep destroying their accounts. Markets offer unlimited opportunities for self-sabotage as well as for self-fulfillment. Acting out your internal conflicts in the marketplace is a very expensive proposition. Traders who are not at peace with themselves often try to fulfill their contradictory wishes in the market. If you do not know where you are going, you will wind up somewhere you never wanted to be. Trading psychology. Your feelings have an immediate impact on your account equity. You may have a brilliant trading system, but if you feel frightened, arrogant, or upset, your account is sure to suffer. When you recognize that a gambler's high or fear is clouding your mind, stop trading. Your success or failure as a trader depends on controlling your emotions. When you trade, you compete against the sharpest minds in the world. The field on which you compete has been slanted to ensure your failure. If you allow your emotions to interfere with your trading, the battle is over. You are responsible for every trade that you make. A trade begins when you decide to enter the market and ends only when you decide to take yourself out. Having a good trading system is not enough. Most traders with good systems wash out of the markets because psychologically they are not prepared to win. Markets offer enormous temptations, like walking through a gold vault or through a harem. Markets evoke powerful greed for more gains and a great fear of losing what we've got. Those feelings cloud our perceptions of opportunities and dangers. Most amateurs feel like geniuses after a winning streak. It is exciting to believe that you are so good you can bend your own rules and succeed. That's when traders deviate from their rules and go into a self-destruct mode. Traders gain some knowledge, they win, their emotions kick in, and they self-destruct. Most traders promptly give their killings back to the markets. The markets are full of rags to riches to rags stories. The hallmark of a successful trader is his ability to accumulate equity. You need to make trading as objective as possible. Keep a diary of all your trades with before and after charts. Keep a spreadsheet listing all your trades, including commissions and slippage, and maintain very strict money management rules. you may have to devote as much energy to analyzing yourself as you do to analyzing the markets. When I was learning how to trade, I read every book on trading psychology I could find. Many writers offered sensible advice. Some stressed discipline. You cannot let the market sway you. Do not make decisions during trading hours. Plan a trade and trade a plan. Others stressed flexibility. Do not enter the market with any preconceived notions. Change your plans when markets change. Some experts suggested isolation. No business news, no Wall Street Journal, no listening to other traders, just you and the markets. Others advised being open-minded, keeping in touch with other traders, and soaking up fresh ideas. Each piece of advice seemed to make sense, but contradicted other equally sensible advice. As a trader, you are in the business of trading. You need to define your businessman's risk, the maximum amount of money you will risk on any single trade. There is no standard dollar amount, just as there is no standard business. An acceptable businessman's risk depends, first of all, on the size of your trading account. It also depends on your trading method and pain tolerance. The concept of a businessman's risk will change the way you manage your money. A sensible trader never risks more than 2% of account equity on any trade. For example, if you have $30,000 in your account, you may not risk more than $600 per trade, and if you have $10,000, you may not risk more than $200. If your account is small, limit yourself to trading less expensive markets or mini contracts. If you see an attractive trade but your stop would have to be placed where more than 2% of equity would be at risk, pass that trade. Avoid risking more than 2% on a trade the way a recovering alcoholic avoids bars. If you are not sure how much to risk, err on the side of caution. If you blame excess commissions on a broker and slippage on a floor trader, you give up control of your trading life. Try to reduce both, but take responsibility for them. If you lose even $1 more than your businessman's risk, including commissions and slippage, you are a loser. Do you keep good trading records? Poor record keeping is a sure sign of a gambler and a loser. Good businessmen keep good records. Your trading records must show the date and price of every entry and exit, slippage, commissions, stops, all adjustments of stops, reasons for entering, objectives for exiting, maximum paper profit, maximum paper loss after a stop was hit, and any other necessary data. If you bail out of a trade within your businessman's risk, it is normal business. There is no bargaining, no waiting for another tick, no hoping for a change. Losing $1 more than your established businessman's risk is like getting drunk, getting into a brawl, getting sick to your stomach on your way home, and waking up in the gutter with a headache. You would never want that to happen. Each trader has his own demons to exorcise on the journey to becoming a successful professional. Here are several rules that worked for me as I grew from a wild amateur into an erratic semi-professional, and finally into a professional trader. You may change this list to suit your personality. 1. Decide that you are in the market for the long haul. That is, you want to be a trader even 20 years from now. 2. Learn as much as you can. Read and listen to experts, but keep a degree of healthy skepticism about everything. Ask questions and do not accept experts at their word. 3. Do not get greedy and rush to trade. Take your time to learn. The markets will be there with more good opportunities in the months and years ahead. 4. Develop a method for analyzing the market. That is, if A happens, then B is likely to happen. The markets have many dimensions. Use several analytic methods to confirm trades. test everything on historical data, and then in the markets using real money. Markets keep changing. You need different tools for trading bull and bear markets and transitional periods, as well as a method for telling the difference. 5. Develop a money management plan. Your first goal must be long-term survival. Your second goal, a steady growth of capital. And your third goal, making high profits. Most traders put the third goal first and are unaware that goals 1 and 2 exist. 6. Be aware that a trader is the weakest link in any trading system. Go to a meeting of Alcoholics Anonymous to learn how to avoid losses or develop your own method for cutting out impulsive trades. 7. Winners think, feel, and act differently than losers. You must look within yourself, strip away your illusions, and change your old ways of being, thinking, and acting. Change is hard, but if you want to be a professional trader, you have to work on changing your personality. Mass psychology. Wall Street is named after a wall that kept farm animals from wandering away from the settlement at the tip of Manhattan. The farming legacy lives on in the language of traders. 4 animals are mentioned especially often on Wall Street: bulls and bears, hogs and sheep. Traders say, bulls make money, bears make money, but hogs get slaughtered. A bull fights by striking up with his horns. A bull is a buyer, a person who bets on a rally and profits from a rise in prices. A bear fights by striking down with his paws. A bear is a seller, a person who bets on a decline and profits from a fall in prices. Hogs are greedy. They get slaughtered when they trade to satisfy their greed. Some hogs buy or sell positions that are too large for them and get destroyed by a small adverse move. Other hogs overstay their positions. They keep waiting for profits to get bigger even after the trend reverses. Sheep are passive and fearful followers of trends, tips, and gurus. They sometimes put on a bull's horns or a bearskin and try to swagger. You recognize them by their pitiful bleating when the market becomes volatile. Whenever the market is open, bulls are buying, bears are selling, hogs and sheep get trampled underfoot, and the undecided traders wait on the sidelines. Quote machines all over the world show a steady stream of quotes, the latest prices for any trading vehicle. Thousands of eyes are focused on each price quote as people make trading decisions. There are 3 groups of traders in the market: buyers, sellers, and undecided traders. Ask is what a seller asks for his merchandise. Bid is what a buyer offers for that merchandise. Buyers and sellers are always in conflict. Buyers want to pay as little as possible, and sellers want to charge as much as possible. If members of both groups insist on having their way, no trade can take place. No trade means no price, only wishful quotes of buyers and sellers. A seller has a choice: to wait until prices rise or to accept a lower offer for his merchandise. A buyer also has a choice: to wait until prices come down or to offer to pay more to the sellers. A trade occurs when there is a momentary meeting of 2 minds. An eager bull agrees to a seller's terms and pays up, or an eager bear agrees to a buyer's terms and sells a little cheaper. The presence of undecided traders puts pressure on both bulls and bears. When a buyer and a seller bargain in private, they may haggle at a leisurely pace. The two must move much faster when they bargain at the exchange. They know that they are surrounded by a crowd of other traders who may butt in on their deal at any moment. The buyer knows that if he thinks for too long, another trader can step in and snap away his bargain. A seller knows that if he tries to hold out for a higher price, another trader may step in and sell at a lower price. The crowd of undecided traders makes buyers and sellers more anxious to accommodate their opponents. A trade occurs when there is a meeting of two minds. Each tick on your quote screen represents a deal between a buyer and a seller. Buyers are buying because they expect prices to rise. Sellers are selling because they expect prices to fall. Buyers and sellers trade while surrounded by crowds of undecided traders. They may become buyers or sellers as prices change or as time passes. Buying by bulls pushes markets up. Selling by bears pushes markets down, and undecided traders make everything happen faster by creating a sense of urgency in buyers and sellers. Traders come to the markets from all over the world, in person, via computers, or through their brokers. Everybody has a chance to buy and to sell. Each price is a momentary consensus of value of all market participants expressed in action. Price is a psychological event, a momentary balance of opinion between bulls and bears. Prices are created by masses of traders, buyers, sellers, and undecided people. The patterns of prices and volume reflect the mass psychology of the markets. Huge crowds converge on stock, commodity, and option exchanges, either in person or represented by their brokers. Big money and little money, smart money and dumb money, institutional money and private money all meet on the exchange floor. Each price represents a momentary consensus of value between buyers, sellers, and undecided traders at the moment of transaction. There is a crowd of traders behind every pattern in the chart book. Crowd consensus changes from moment to moment. Sometimes it gets established in a very low-key environment, and at other times, the environment turns wild. Prices move in small increments during quiet times. When a crowd becomes either spooked or elated, prices begin to jump. Imagine bidding for a life preserver aboard a sinking ship. That's how prices leap when masses of traders become emotional about a trend. An astute trader tries to enter the market during quiet times and take profits during wild times. Technical analysts study swings of mass psychology in the financial markets. Each trading session is a battle between bulls, who make money when prices rise, and bears, who profit when prices fall. The goal of technical analysts is to discover the balance of power between bulls and bears and bet on the winning group. If bulls are much stronger, you should buy and hold. If bears are much stronger, you should sell and sell short. If both camps are about equal in strength, a wise trader stands aside. He lets bullies fight with each other and puts on a trade only when he is reasonably sure who is likely to win. Prices, volume, and open interest reflect crowd behavior. So do the indicators that are based on them. This makes technical analysis similar to poll-taking. Both combine science and art. They are scientific to the extent that we use statistical methods in computers. They are artistic to the extent that we use personal judgment to interpret our findings. What is the reality behind market symbols, prices, numbers, and graphs? When you check prices in your newspaper, watch quotes on your screen, or plot an indicator on your chart, what exactly are you looking at? What is the market that you want to analyze and trade? Amateurs act as if the market is a giant happening, a ball game in which they can join the professionals and make money. Traders from a scientific or engineering background often treat the market as a physical event. They apply to it the principles of signal processing, noise reduction, and similar ideas. By contrast, all professional traders know full well what the market is. It is a huge mass of people. Every trader tries to take money away from other traders by outguessing them on the probable direction of the market. The members of the market crowd live on different continents. They are united by modern telecommunications in the pursuit of profit at each other's expense. The market is a huge crowd of people. Each member of the crowd tries to take money away from other members by outsmarting them. The market is a uniquely harsh environment because everyone is against you and you are against everyone. Not only is the market harsh, you have to pay high prices for entering and exiting it. You have to jump over 2 high barriers, commissions and slippage, before you can collect a dime. The moment you place an order, you owe your broker a commission. You are behind the game before you begin. Then floor traders try to hit you with slippage when your order arrives on the floor. They try to take another bite out of your account when you exit your trade. In trading, you compete against some of the brightest minds in the world while fending off the piranhas of commissions and slippage. Private traders usually come to the market after a successful career in business or in the professions. An average private futures trader in the United States is a 50-year-old, married, college-educated man. Many futures traders own their own businesses, and many have postgraduate degrees. The 2 largest occupational groups among futures traders are farmers and engineers. Most people trade for partly rational, partly irrational reasons. Rational reasons include the desire to earn a large return on capital. Irrational reasons include gambling and a search for excitement. Most traders are not aware of their irrational motives. Learning to trade takes hard work, time, energy, and money. Few individuals rise to the level of professionals who can support themselves by trading. Professionals are extremely serious about what they do. They satisfy their irrational goals outside the markets, while amateurs act them out in the marketplace. The major economic role of a trader is to support his broker, to help him pay his mortgage and keep his children in private schools. In addition, the role of a speculator is to help companies raise capital in the stock market and to assume a price risk in the commodities markets, allowing producers to focus on production. These lofty economic goals are far from a speculator's mind when he gives an order to his broker. Institutions are responsible for a huge volume of trading. Their deep pockets give them several advantages. They pay low institutional commissions. They can afford to hire the best researchers, brokers, and traders. Some even strike back at floor traders who steal too much in slippage. The spate of arrests and trials of Chicago floor traders in 1990 and 1991 began when Archer Daniels Midland, a food processing firm, brought in the FBI. A friend of mine who heads a trading desk at a bank bases some of his decisions on a service provided by a group of former CIA officers. They scan the media to detect early trends in society and send their reports to him. My trader friend culls some of his best ideas from these reports. The substantial annual fee for those experts is small potatoes for his firm compared with the millions of dollars it trades. Most private traders do not have such opportunities. It is easier for institutions to buy the best research. An acquaintance who used to trade successfully for a Wall Street investment bank found himself in trouble when he quit to trade for himself. He discovered that a real-time quote system in his Park Avenue apartment in Manhattan did not give him news as fast as the squawk box on the trading floor of his old firm. Brokers from around the country used to call him with the latest ideas because they wanted his orders. When you trade from your house, you are never the first to hear the news, he says. Some large firms have intelligence networks that enable them to act before the public. One day, when oil futures rallied in response to a fire on a platform in the North Sea, I called a friend at an oil firm. The market was frantic, but he was relaxed. He had bought oil futures half an hour before they exploded. He had gotten a telex from an agent in the area of the fire well before the reports appeared on the newswire. Timely information is priceless, but only a large company can afford an intelligence network. The firms that deal in both futures and cash markets have two advantages. They have true inside information, and they are exempt from speculative position limits. Recently, I visited an acquaintance at a multinational oil company. After passing through security that was tighter than at Kennedy International Airport, I walked through glass-enclosed corridors. Clusters of men huddled around monitors trading oil products. When I asked my host whether his traders were hedging or speculating, he looked me straight in the eye and said, "Yes." I asked again and received the same answer. Companies crisscross the thin line between hedging and speculating based on inside information. Employees of trading firms have a psychological advantage. They can be more relaxed because their own money is not at risk. Most individuals do not have the discipline to stop trading when they get on a losing streak, but institutions impose discipline on traders. A trader is given two limits: how much he may risk on a single trade, and the maximum amount he may lose in a month. These limits work as stop-loss orders on a trader. With all these advantages, how can an individual trader compete against institutions and win? First, many institutional trading departments are poorly run. Second, the Achilles heel of most institutions is that they often have to trade, while an individual trader is free to trade or stay out of the market. Banks have to be active in the bond market, and food processing companies have to be active in the grain market at almost any price. An individual trader is free to wait for the best trading opportunities. Most private traders fritter away this advantage by overtrading. An individual who wants to succeed against the giants must develop patience and eliminate greed. Remember, your goal is to trade well, not to trade often. Successful institutional traders receive raises and bonuses. Even a high bonus can feel puny to someone who earns many millions of dollars for his firm. Successful institutional traders often talk of quitting and going to trade for themselves. Most traders who leave institutions get caught up in the emotions of fear, greed, elation, and panic when they start risking their own money. They seldom do well trading for their own account. Another sign that psychology is at the root of trading success or failure. The market crowd and you. The market is a loosely organized crowd whose members bet that prices will rise or fall. Since each price represents the consensus of the crowd at the moment of transaction, all traders are in effect betting on the future mood of the crowd. That crowd keeps swinging from indifference to optimism or pessimism, and from hope to fear. Most people do not follow their own trading plans because they let the crowd influence their feelings, thoughts, and actions. Bulls and bears battle in the market, and the value of your investment sinks or soars depending on the actions of total strangers. You cannot control the markets. You can only decide whether and when to enter or exit trades. Most traders feel jittery when we enter a trade. Their judgment becomes clouded by emotions after they join the market crowd. These crowd-induced emotions make traders deviate from their trading plans and lose money. Charles Mackay, a Scottish barrister, wrote his classic book, Extraordinary Popular Delusions and the Madness of Crowds, in 1841. He described several mass manias, including the tulip mania in Holland in 1634 and the South Seas investment bubble in England in 1720. The tulip craze began as a bull market in tulip bulbs. The long bull market convinced the prosperous Dutch that tulips would continue to appreciate. Many of them abandoned their businesses to grow tulips, trade them, or become tulip brokers. Banks accepted tulips as collateral and speculators profited. Finally, that mania collapsed in waves of panic selling, leaving many people destitute and the nation shocked. Mackay sighed. Men go mad in crowds, and they come back to their senses slowly and one by one. In 1897, Gustave Le Bon, a French philosopher and politician, wrote The Crowd, one of the best books on mass psychology. A trader who reads it today can see his reflection in a century-old mirror. Le Bon wrote that when people gather in a crowd, whoever be the individuals that compose it, however like or unlike be their mode of life, their occupations, their character, or their intelligence, the fact that they have been transformed into a crowd puts them in possession of a sort of collective mind which makes them feel, think, and act in a manner quite different from that in which each individual of them would feel, think, and act were he in a state of isolation. People change when they join crowds. They become more credulous and impulsive, anxiously search for a leader, and react to emotions instead of using their intellect. An individual who becomes involved in a group becomes less capable of thinking for himself. You need to base your trades on a carefully prepared trading plan and not jump in response to price changes. It pays to write down your plan. You need to know exactly under what conditions you will enter and exit a trade. Do not make decisions on the spur of the moment, when you are vulnerable to being sucked into the crowd. You can succeed in trading only when you think and act as an individual. The weakest part of any trading system is the trader himself. Traders fail when they trade without a plan or deviate from their plans. Plans are created by reasoning individuals. Impulsive trades are made by sweaty group members. You have to observe yourself and notice changes in your mental state as you trade. Write down your reasons for entering a trade and the rules for getting out of it, including money management rules. You must not change your plan while you have an open position. Sirens were sea creatures of Greek myths who sang so beautifully that sailors jumped overboard and drowned. When Odysseus wanted to hear the sirens' songs, he ordered his men to tie him to the mast and to put wax in their own ears. Odysseus heard the sirens' songs, but survived because he could not jump. You ensure your survival as a trader when on a clear day you tie yourself to the mast of a trading plan and money management rules. Psychology of trends. Each price is the momentary consensus of value of all market participants. It shows their latest vote on the value of a trading vehicle. Any trader can put in his 2 cents worth by giving an order to buy or to sell or by refusing to trade at the current level. Each bar on a chart reflects the battle between bulls and bears. When bulls feel strongly bullish, they buy more eagerly and push markets up. When bears feel strongly bearish, they sell more actively and push markets down. Each price reflects action or lack of action by all traders in the market. Charts are a window into mass psychology. When you analyze charts, you analyze the behavior of traders. Technical indicators help make this analysis more objective. Technical analysis is applied social psychology. It aims to recognize trends and changes in crowd behavior in order to make intelligent trading decisions. Ask most traders why prices went up, and you are likely to get a stock answer. More buyers than sellers. This is not true. The number of trading instruments, such as stocks or futures, bought and sold in any market is always equal. If you want to buy a contract of Swiss francs, someone has to sell it to you. If you want to sell short a contract of the S&P 500, someone has to buy it from you. The number of stocks bought and sold is equal in the stock market. Furthermore, the number of long and short positions in the futures markets is always equal. Prices move up or down because of changes in the intensity of greed and fear among buyers or sellers. When the trend is up, bulls feel optimistic and do not mind paying a little extra. They buy high because they expect prices to rise even higher. Bears feel tense in an uptrend, and they agree to sell only at a higher price. When greedy and optimistic bulls meet fearful and defensive bears, the market rallies. The stronger their feelings, the sharper the rally. The rally ends only when many bulls lose their enthusiasm. When prices slide, bears feel optimistic and do not quibble about selling short at lower prices. Bulls are fearful and agree to buy only at a discount. As long as bears feel like winners, they continue to sell at lower prices and the downtrend continues. It ends when bears start feeling cautious and refuse to sell at lower prices. Few traders act as purely rational human beings. There is a great deal of emotional activity in the markets. Most market participants act on the principle of monkey see, monkey do. The waves of fear and greed sweep up bulls and bears. Markets rise because of greed among buyers and fear among short sellers. Bulls normally like to buy on the cheap. When they turn very bullish, they become more concerned with not missing the rally than with getting a cheap price. A rally continues as long as bulls are greedy enough to meet sellers' demands. The sharpness of a rally depends on how traders feel. If buyers feel just a little stronger than sellers, the market rises slowly. When they feel much stronger than sellers, the market rises fast. It is the job of a technical analyst to find when buyers are strong and when they start running out of steam. Short sellers feel trapped by rising markets as their profits melt and turn into losses. When short sellers rush to cover, a rally becomes nearly vertical. Fear is a stronger emotion than greed, and rallies driven by short covering are especially sharp. Markets fall because of greed among bears and fear among bulls. Normally, bears prefer to sell short on rallies, but if they expect to make a lot of money on a decline, they don't mind shorting on the way down. Fearful buyers agree to buy only below the market. As long as short sellers are willing to meet those demands and sell at a bid, the decline continues. As bulls' profits melt and turn into losses, they panic and sell at almost any price. They are so eager to get out that they hit the bids under the market. Markets can fall very fast when hit by panic selling. Buying by happy bulls and covering by fearful bears pushes uptrends higher. Buyers feel rewarded while sellers feel punished. Both feel emotionally involved, but few traders realize that they are creating the uptrend, creating their own leader. Eventually, a price shock occurs. A major sale hits the market, and there are not enough buyers to absorb it. The uptrend takes a dive. Bulls feel mistreated, like children whose father hit them with a strap during a meal. But bears feel encouraged. A price shock plants the seeds of an uptrend's reversal. Even if the market recovers and reaches a new high, bulls feel more skittish and bears become bolder. This lack of cohesion in the dominant group and optimism among its opponents makes the uptrend ready to reverse. Several technical indicators identify tops by tracing a pattern called bearish divergence. It occurs when prices reach a new high, but the indicator reaches a lower high than it did on a previous rally. Bearish divergences mark the best shorting opportunities. When the trend is down, bears feel like good children, praised and rewarded for being smart. They feel increasingly confident, add to their positions, and the downtrend continues. New bears come into the market. Most people admire winners, and the financial media keep interviewing bears in bear markets. Bulls lose money in downtrends, and that makes them feel bad. Bulls dump their positions, and many switch sides to join bears. Their selling pushes markets lower. After a while, bears grow confident and bulls feel demoralized. Suddenly, a price shock occurs. A cluster of buy orders soaks up all available sell orders and lifts the market. Now bears feel like children whose father has lashed out at them in the midst of a happy meal. A price shock plants the seeds of a downtrend's eventual reversal because bears become more fearful and bulls grow bolder. When a child begins to doubt that Santa Claus exists, he seldom believes in Santa again. Even if bears recover and prices fall to a new low, several technical indicators identify their weakness by tracing a pattern called a bullish divergence. It occurs when prices fall to a new low, but an indicator traces a more shallow bottom than during the previous decline. An individual has a free will, and his behavior is hard to predict. Group behavior is more primitive and easier to follow. When you analyze markets, you analyze group behavior. You need to identify the direction in which groups run and their changes. Groups suck us in and cloud our judgment. The problem for most analysts is that they get caught in the mentality of the groups they analyze. The longer a rally continues, the more technicians get caught up in bullish sentiment, ignore the danger signs, and miss the reversal. The longer a decline goes on, the more technicians get caught up in bearish gloom and ignore bullish signs. This is why it helps to have a written plan for analyzing the markets. We have to decide in advance what indicators we will watch and how we will interpret them. Floor traders use several tools for tracking the quality and intensity of a crowd's feelings. They watch the crowd's ability to break through recent support and resistance levels. They keep an eye on the flow of paper, customer orders that come to the floor in response to price changes. Floor traders listen to the changes in pitch and volume of the roar on the exchange floor. If you trade away from the floor, you need other tools for analyzing crowd behavior. Your charts and indicators reflect mass psychology in action. A technical analyst is an applied social psychologist, often armed with a computer. Technical analysts believe that prices reflect everything known about the market, including all fundamental factors. Each price represents the consensus of value of all market participants. Large commercial interests and small speculators, fundamental researchers, technicians, and gamblers. Technical analysis is a study of mass psychology. It is partly a science and partly an art. Technicians use many scientific methods, including mathematical concepts of game theory, probabilities, and so on. Many technicians use computers to track sophisticated indicators. Technical analysis is also an art. The bars on a chart coalesce into patterns and formations. When prices and indicators move, they produce a sense of flow and rhythm, a feeling of tension and beauty that helps you sense what is happening and how to trade. Individual behavior is complex, diverse, and difficult to predict. Group behavior is primitive. Technicians study the behavior patterns of market crowds. They trade when they recognize a pattern that preceded past market moves. A tremendous volume of information pours out of the markets during trading hours. Changes in prices tell us about the battles of bulls and bears. Your job is to analyze this information and bet on the dominant market group. Dramatic forecasts are a marketing gimmick. People who sell advisory services or raise money know that good calls attract paying customers, while bad calls are quickly forgotten. My phone rang while I was writing this chapter. One of the famous gurus, currently down on his luck, told me that he identified a once-in-a-lifetime buying opportunity in a certain agricultural market. He asked me to raise money for him and promised to multiply it 100-fold in 6 months. I do not know how many fools he hooked, but dramatic forecasts have always been good for fleecing the public. Use your common sense when you analyze markets. When some new development puzzles you, compare it to life outside the markets. For example, indicators may give you buy signals in 2 markets. Should you buy the market that declined a lot before the buy signal, or the one that declined a little? Compare this to what happens to a man after a fall. If he falls down a flight of stairs, he may dust himself off and run up again. But if he falls out of a third-story window, he's not going to run anytime soon. He needs time to recover. Prices seldom rally very hard immediately after a bad decline. Successful trading stands on three pillars. You need to analyze the balance of power between bulls and bears. You need to practice good money management. You need personal discipline to follow your trading plan and avoid getting high in the markets. Classical chart analysis. Chartists study market action, trying to identify recurrent price patterns. Their goal is to profit from trading when patterns recur. Most chartists work with bar graphs showing high, low, and closing prices and volume. Some also watch opening prices and open interest. Point-and-figure chartists track only price changes and ignore time, volume, and open interest. Classical charting requires only a pencil and paper. It appeals to visually oriented people. Those who plot data by hand often develop a physical feel for prices. Computers speed charting at a cost of losing some of that feel. The biggest problem in charting is wishful thinking. Traders often convince themselves that a pattern is bullish or bearish depending on whether they want to buy or to sell. Chart patterns reflect the tides of greed and fear among traders. This book focuses on daily charts, but you can apply many of its principles to other data. The rules for reading weekly, daily, hourly, or intraday charts are very similar. Each price is a momentary consensus of value of all market participants expressed in action. Each price bar provides several pieces of information about the balance of power between bulls and bears. The opening price of a daily or a weekly bar usually reflects the amateur's opinion of value. They read morning papers, find out what happened the day before, and call their brokers with orders before going to work. Amateurs are especially active early in the day and early in the week. Traders who researched the relationship between opening and closing prices for several decades found that opening prices most often occur near the high or the low of the daily bars. Buying or selling by amateurs early in the day creates an emotional extreme from which prices recoil later in the day. In bull markets, prices often make their low for the week on Monday or Tuesday on profit-taking by amateurs, then rally to a new high on Thursday or Friday. In bear markets, the high for the week is often set on Monday or Tuesday, with a new low toward the end of the week on Thursday or Friday. The closing prices of daily and weekly bars tend to reflect the actions of professional traders. They watch the markets throughout the day, respond to changes, and become especially active near the close. Many of them take profits at that time to avoid carrying trades overnight. Professionals, as a group, usually trade against the amateurs. They tend to buy lower openings, sell short higher openings, and unwind their positions as the day goes on. Traders need to pay attention to the relationship between opening and closing prices. If prices closed higher than they opened, then market professionals were probably more bullish than amateurs. If prices closed lower than they opened, then market professionals were probably more bearish than amateurs. It pays to trade with the professionals and against the amateurs. Efficient markets, random walk, and nature's law. Efficient market theory is an academic notion that nobody can outperform the market because any price at any given moment incorporates all available information. Warren Buffett, one of the most successful investors of our century, commented, "I think it's fascinating how the ruling orthodoxy can cause a lot of people to think the earth is flat. Investing in a market where people believe in efficiency is like playing bridge with someone who's been told it doesn't do any good to look at the cards. The logical flaw of efficient market theory is that it equates knowledge with action. People may have knowledge, but the emotional pull of the crowd often leads them to trade irrationally. A good analyst can detect repetitive patterns of crowd behavior on his charts and exploit them. Random walk theorists claim that market prices change at random. Of course, there is a fair amount of randomness or noise in the markets, just as there is randomness in any other crowd milling around. An intelligent observer can identify repetitive behavior patterns of a crowd and make sensible bets on their continuation or reversal. People have memories. They remember past prices, and their memories influence their buying and selling decisions. Memories help create support under the market and resistance above it. Random walkers deny that memories of the past influence our behavior in the present. As Milton Friedman has pointed out, prices carry information about the availability of supply and the intensity of demand. Market participants use that information to make their buying and selling decisions. For example, consumers buy more merchandise when it is on sale and less when prices are high. Financial traders are just as capable of logical behavior as homemakers in a supermarket. When prices are low, bargain hunters step in. A shortage can lead to a buying panic, but high prices choke off demand. Nature's law is the rallying cry of a clutch of mystics who oppose random walkers in the financial markets. Mystics claim that there is a perfect order in the markets, which they say move like clockwork in response to immutable natural laws. R.N. Elliott even titled his last book, Nature's Law. The perfect order crowd gravitates to astrology and looks for links between prices and the movements of the planets. Most mystics try to hide their astrological bent, but it is easy to draw them out of a shell. Next time someone talks to you about natural order in the markets, ask him about astrology. He will probably jump at the chance to come out of the closet and talk about the stars. Those who believe in perfect order in the markets accept that tops and bottoms can be predicted far into the future. Amateurs love forecasts, and mysticism provides a great marketing gimmick. It helps sell courses, trading systems, and newsletters. Mystics, random walk academics, and efficient market theorists have one trait in common. They are equally divorced from the reality of the markets. Extremists argue with one another, but they think alike. Support and resistance. A ball hits the floor and bounces. It drops after it hits the ceiling. Support and resistance are like a floor and a ceiling, with prices sandwiched between them. Understanding support and resistance is essential for understanding price trends and chart patterns. Rating their strength helps you decide whether the trend is likely to continue or to reverse. Support is a price level where buying is strong enough to interrupt or reverse a downtrend. When a downtrend hits support, it bounces like a diver who hits the bottom and pushes away from it. Support is represented on a chart by a horizontal or near horizontal line connecting several bottoms. Resistance is a price level where selling is strong enough to interrupt or reverse an uptrend. When an uptrend hits resistance, it stops or tumbles down like a man who hits his head on a branch while climbing a tree. Resistance is represented on a chart by a horizontal or near horizontal line connecting several tops. Minor support or resistance causes trends to pause, while major support or resistance causes them to reverse. Traders buy at support and sell at resistance, making their effectiveness a self-fulfilling prophecy. Support and resistance exist because people have memories. Our memories prompt us to buy and sell at certain levels. Buying and selling by crowds of traders creates support and resistance. If traders remember that prices have recently stopped falling and turned up from a certain level, they are likely to buy when prices approach that level again. If traders remember that an uptrend has recently reversed after rising to a certain peak, they tend to sell and go short when prices approach that level again. For example, all major rallies in the stock market from 1966 until 1982 ended whenever the Dow Jones Industrial Average rallied to 950 or 1050. The resistance was so strong that traders named it a graveyard in the sky. Once the bulls rammed the market through that level, it became a major support area. Support and resistance exist because masses of traders feel pain and regret. Traders who hold losing positions feel intense pain. Losers are determined to get out as soon as the market gives them another chance. Traders who missed an opportunity feel regret and also wait for the market to give them a second chance. Feelings of pain and regret are mild in trading ranges where swings are small and losers do not get hurt too badly. Breakouts from trading ranges create intense pain and regret. When the market stays flat for a while, traders get used to buying at the lower edge of the range and shorting at the upper edge. In uptrends, bears who sold short feel pain and bulls feel regret that they did not buy more. Both feel determined to buy if the market gives them a second chance. The pain of bears and regret of bulls make them ready to buy, creating support during reactions in an uptrend. Resistance is an area where bulls feel pain, bears feel regret, and both are ready to sell. When prices break down from a trading range, bulls who bought feel pain, feel trapped, and wait for a rally to let them get out even. Bears regret that they have not shorted more and wait for a rally to give them a second chance to sell short. Bulls' pain and bears' regret create resistance, a ceiling above the market in downtrends. The strength of support and resistance depends on the strength of feelings among masses of traders. A congestion area that has been hit by several trends is like a cratered battlefield. Its defenders have plenty of cover, and an attacking force is likely to slow down. The longer prices stay in a congestion zone, the stronger the emotional commitment of bulls and bears to that area. When prices approach that zone from above, it serves as support. When prices rally into it from below, it acts as resistance. A congestion area can reverse its role and serve as either support or resistance. The strength of every support or resistance zone depends on three factors: its length, its height, and the volume of trading that has taken place in it. You can visualize these factors as the length, the width, and the depth of a congestion zone. The longer a support or resistance area, its length of time or the number of hits it took, the stronger it is. Support and resistance, like good wine, become better with age. A 2-week trading range provides only minimal support or resistance. A 2-month range gives people time to become used to it and creates intermediate support or resistance, while a 2-year range becomes accepted as a standard of value and offers major support or resistance. As support and resistance levels grow old, they gradually become weaker. Losers keep washing out of the markets, replaced by newcomers who do not have the same emotional commitment to old price levels. People who lost money only recently remember full well what happened to them. They are probably still in the market, feeling pain and regret, trying to get even. People who made bad decisions several years ago are probably out of the markets, and their memories matter less. The strength of support and resistance increases each time that area is hit. When traders see that prices have reversed at a certain level, they tend to bet on a reversal the next time prices reach that level. The taller the support and resistance zone, the stronger it is. A tall congestion zone is like a tall fence around a property. A congestion zone whose height equals 1% of current market value, 4 points in the case of the S&P 500 at 400, provides only minor support or resistance. A congestion zone that is 3% tall provides intermediate support or resistance, and a congestion zone that is 7% tall or higher can grind down a major trend. The greater the volume of trading in a support and resistance zone, the stronger it is. High volume in a congestion area shows active involvement by traders, a sign of strong emotional commitment. Low volume shows that traders have little interest in transacting at that level, a sign of weak support or resistance. Trading rules. 1. Whenever the trend you are riding approaches support or resistance, tighten your protective stop. A protective stop is an order to sell below the market when you are long, or to cover shorts above the market when you are short. This stop protects you from getting badly hurt by an adverse market move. A trend reveals its health by how it acts when it hits support or resistance. If it is strong enough to penetrate that zone, it accelerates, and your tight stop is not touched. If a trend bounces away from support or resistance, it reveals its weakness. In that case, your tight stop salvages a good chunk of profits. 2. Support and resistance are more important on long-term charts than on short-term charts. Weekly charts are more important than dailies. A good trader keeps an eye on several time frames and defers to the longer one. If the weekly trend is sailing through a clear zone, the fact that the daily trend is hitting resistance is less important. When a weekly trend approaches support or resistance, you should be more inclined to act. 3. Support and resistance levels are useful for placing stop-loss and protect-profit orders. The bottom of a congestion area is the bottom line of support. If you buy and place your stop below that level, you give the uptrend plenty of room. More cautious traders buy after an upside breakout and place a stop in the middle of a congestion area. A true upside breakout should not be followed by a pullback into the range, just as a rocket is not supposed to sink back to its launching pad. Reverse this procedure in downtrends. Many traders avoid placing stops at round numbers. This superstition began with the off-the-cuff advice by Edwards and McGee to avoid placing stops at round numbers because everybody was placing them there. Now, if traders buy copper at 92, they place a stop at 89.75 rather than 90. When they sell a stock short at 76, they place a protective stop at 80.25 rather than 80. These days, there are fewer stops at round numbers than at fractional numbers. It is better to place your stops at logical levels, round or not. Markets spend more time in trading ranges than they do in trends. Most breakouts from trading ranges are false breakouts. They suck in trend followers just before prices return into the trading range. A false breakout is the bane of amateurs, but professional traders love them. Professionals expect prices to fluctuate without going very far most of the time. They wait until an upside breakout stops reaching new highs or a downside breakout stops making new lows. Then they pounce. They fade the breakout, trade against it, and place a protective stop at the latest extreme point. It is a very tight stop, and their risk is low, while there is a big profit potential from a pullback into the congestion zone. The risk-reward ratio is so good that professionals can afford to be wrong half the time and still come out ahead of the game. The best time to buy an upside breakout on a daily chart is when your analysis of the weekly chart suggests that a new uptrend is developing. True breakouts are confirmed by heavy volume, while false breakouts tend to have light volume. True breakouts are confirmed when technical indicators reach new extreme highs or lows in the direction of the trend, while false breakouts are often marked by divergences between prices and indicators. Traders try to profit from changes in prices. Buy low and sell high, or sell short high and cover low. Even a quick look at a chart reveals that markets spend most of their time in trading ranges. They spend less time in trends. A trend exists when prices keep rising or falling over time. In an uptrend, Each rally reaches a higher high than the preceding rally, and each decline stops at a higher level than the preceding decline. In a downtrend, each decline falls to a lower low than the preceding decline, and each rally stops at a lower level than the preceding rally. In a trading range, most rallies stop at about the same high, and declines peter out at about the same low. A trader needs to identify trends and trading ranges. It is easier to trade during trends. It is harder to make money when prices are flat unless you write options, which requires a special skill. Trading in trends and in trading ranges calls for different tactics. When you go long in an uptrend or sell short in a downtrend, you have to give that trend the benefit of the doubt and not be shaken out easily. It pays to buckle your seatbelt and hang on for as long as the trend continues. When you trade in a trading range, you have to be nimble and close out your position at the slightest sign of a reversal. Another difference in trading tactics between trends and trading ranges is the handling of strength and weakness. You have to follow strength during trends, buy in uptrends, and sell short in downtrends. When prices are in a trading range, you have to do the opposite, buy weakness and sell strength. An uptrend emerges when bulls are stronger than bears and their buying forces prices up. If bears manage to push prices down, bulls return in force, break the decline, and force prices to a new high. Downtrends occur when bears are stronger and their selling pushes markets down. When a flurry of buying lifts prices, bears sell short into that rally, stop it, and send prices to new lows. When bulls and bears are equally strong or weak, prices stay in a trading range. When bulls manage to push prices up, bears sell short into that rally and prices fall. Bargain hunters step in and break the decline. Bears cover shorts, their buying fuels a minor rally, and the cycle repeats. A trading range is like a fight between two equally strong gangs. They push one another back and forth on a street corner, but neither can control the turf. A trend is like a fight where a stronger gang chases the weaker gang down the street. Every once in a while, the weaker gang stops and puts up a fight, but then is forced to turn and run again. Prices in trading ranges go nowhere, just as crowds spend most of their time in aimless milling. Markets spend more time in trading ranges than in trends because aimlessness is more common among people than purposeful action. When a crowd becomes agitated, it surges and creates a trend. Crowds do not stay excited for long. They go back to meandering. Professionals tend to give the benefit of the doubt to trading ranges. Identifying trends and trading ranges is one of the hardest tasks in technical analysis. It is easy to find them in the middle of a chart, but the closer you get to the right edge, the harder it gets. Trends and trading ranges clearly stand out on old charts. Experts show those charts at seminars and make it seem easy to catch trends. Trouble is, your broker does not allow you to trade in the middle of the chart. He says you must make your trading decisions at the hard right edge of the chart. The past is fixed and easy to analyze. The future is fluid and uncertain. By the time you identify a trend, a good chunk of it is gone. Nobody rings a bell when a trend dissolves into a trading range. By the time you recognize that change, you will lose some money trying to trade as if the market was still trending. Many chart patterns and indicator signals contradict one another at the right edge of the chart. You have to base your decisions on probabilities in an atmosphere of uncertainty. Most people cannot accept uncertainty. They have a strong emotional need to be right. They hang on to losing positions, waiting for the market to turn and make them whole. Trying to be right in the market is very expensive. Professional traders get out of losing trades fast. When the market deviates from your analysis, you have to cut losses without fuss or emotions. When you identify an uptrend and decide to buy, you have to decide whether to buy immediately or wait for a dip. If you buy fast, you get in gear with the trend, but your stops are likely to be farther away and you risk more. If you wait for a dip, you will risk less, but will have 4 groups of competitors. Longs who want to add to their positions, shorts who want to get out even, traders who never bought, and traders who sold too early but are eager to buy. The waiting area for a pullback is very crowded. Markets are not known for their charity, and a deep pullback may well signal the beginning of a reversal. This reasoning also applies to downtrends. Waiting for pullbacks while a trend is gathering steam is an amateur's game. If the market is in a trading range and you are waiting for a breakout, you have to decide whether to buy in anticipation of a breakout, during a breakout, or on a pullback after a valid breakout. If you trade multiple positions, you can buy a third in anticipation, a third on a breakout, and a third on a pullback. Whatever method you use, there is one money management rule that will keep you out of the riskiest trades. The distance from the entry point to the level of a protective stop should never be more than 2% of your account equity. No matter how attractive a trade is, pass it up if it requires a wider stop. Money management tactics are different in trends and trading ranges. It pays to put on a smaller position in a trend, but use a wider stop. Then you will be less likely to get shaken out by reactions while you keep risk under control. You may put on a bigger position in a trading range, but use a tighter stop. Finding good entry points is extremely important in trading ranges. You have to be very precise because the profit potential is so limited. A trend is more forgiving of a sloppy entry as long as you trade in the direction of the trend. Old traders chuckle. Do not confuse brains with a bull market. When you cannot tell whether the market is in a trend or in a trading range, remember that professionals give the benefit of the doubt to trading ranges. If you are not sure, stand aside. Professionals love trading ranges because they can slide in and out of positions with little risk of being impaled on a trend. Since they pay low or no commissions and suffer little slippage, it is profitable for them to trade in gently fluctuating markets. Those of us who trade away from the floor are better off trying to catch trends. You can trade less frequently during trends, and your account suffers less from commissions and slippage. Most traders ignore the fact that markets usually are both in a trend and in a trading range at the same time. They pick one time frame, such as daily or hourly, and look for trades on daily charts. With their attention fixed on daily or hourly charts, trends from other time frames, such as weekly or 10-minute trends, keep sneaking up on them and wreaking havoc with their plans. Markets exist in several time frames simultaneously. They exist on a 10-minute chart, an hourly chart, a daily chart, a weekly chart, and any other chart. The market may look like a buy on a daily chart, but a sell on a weekly chart, and vice versa. The signals in different time frames of the same market often contradict one another. Which of them will you follow? When you are in doubt about a trend, step back and examine the charts at a time frame that is larger than the one you are trying to trade. This search for a greater perspective is one of the key principles of the triple screen trading system. A losing trader often thinks he would be better off if he had a real-time quote machine on his desk. One of the universal fantasies of losers is that they would be winners if they could get their data faster and focused on a shorter time frame. But they lose money even faster with a quote system. When that happens, some losers say they would be better off trading right on the exchange floor without any delay for data transmission. But more than half of floor traders wash out in their first year. Being in the middle of the action does not do losers any good. The conflicting signals in different time frames of the same market are one of the great puzzles in market analysis. What looks like a trend on a daily chart may show up as a blip on a flat weekly chart, What looks like a flat trading range on a daily chart shows rich uptrends and downtrends on an hourly chart, and so on. When professionals are in doubt, they look at the big picture, but amateurs focus on the short-term charts. Trend lines. Charts reveal the actions of bulls and bears. Bottoms of declines show where bears stopped and bulls regained control of the market. Peaks of rallies show where bulls ran out of steam and bears gained control. A line connecting two nearby bottoms shows the lowest common denominator of bullish power. A line that connects two nearby tops shows the lowest common denominator of the power of bears. Those lines are called trend lines. Traders use them to identify trends. When prices rally, draw an uptrend line across the bottoms. When prices decline, draw a downtrend line across the tops. Projecting those lines into the future helps anticipate buying and selling points. The most important feature of a trend line is its angle. It identifies the dominant market force. When a trend line points up, it shows that bulls are in control. Then it pays to buy with a protective stop below the trend line. When a trend line points down, it shows that bears are in control. Then it pays to sell short and protect your position with a stop above the trend line. Most chartists draw a trend line through extreme high and low points, but it is better to draw it through the edges of congestion areas. Those edges show where the majority of traders have reversed direction. Technical analysis is poll-taking, and poll-takers want to track opinions of masses, not of a few extremists. Drawing trend lines through the edges of congestion areas is somewhat subjective. You have to watch out for the temptation to slant your ruler. Panic dumping by bulls at the bottoms and panic covering by bears at the tops create extremes, which appear as long tails on the charts. You want to base your trend lines on the edges of congestion areas and not on tails, because tails show little about the crowd other than its tendency to panic. The extreme points are very important, but not for drawing trend lines. Markets usually recoil from those tails, offering opportunities to short-term traders. A bar that looks like a finger sticking out of a tight chart pattern provides a valuable reference point for short-term traders. Markets constantly fluctuate, seeking an area that generates the highest volume of trading. A tail shows that a certain price has been rejected by the market. It usually leads to a swing in the opposite direction. As soon as you recognize a tail, trade against it. Place your protective stop halfway through the tail. If the market starts chewing its tail, it is time to get out. The single most important feature of a trend line is its slope. When a trend line slants up, bulls are in control, and it pays to look for buying opportunities. When a trend line slants down, bears are in control, and it pays to look for shorting opportunities. You can rate the importance of any trend line by examining 5 factors: the time frame of the trend line, its length, the number of times prices touch it, its angle, and volume. The longer the time frame, the more important the trend line. A trend line on a weekly chart identifies a more important trend than a daily trend line. A trend line on a daily chart identifies a more important trend than an hourly trend line, and so on. The longer the trend line, the more valid it is. A short trend line reflects mass behavior over a short period. A longer trend line reflects mass behavior over a longer time. The longer a trend continues, the greater its inertia. A major bull market may follow its trend line for several years. The more contacts between prices and trend line, the more valid that line. When the trend is up, a return to the trend line shows a rebellion among bears. When the trend is down, a rally to the trend line shows a rebellion by the bulls. When prices pull back to a trend line and then bounce away from it, you know that the dominant market group has beaten the rebels. A preliminary trend line is drawn across only 2 points. 3 points of contact make that line more valid.
4 or 5 points of contact show that the dominant market crowd is firmly in control.
The angle between a trend line and the horizontal axis reflects the emotional intensity of the dominant market crowd. A steep trend line shows that the dominant crowd is moving rapidly. A relatively flat trend line shows that the dominant crowd is moving slowly. A shallow trend line is likely to last longer, like a turtle racing against a hare. It pays to measure the angle of every trend line and write it down on your chart. This can be done using a computer, a protractor, or a Chinese charting tool. Comparing angles of trend lines shows whether the dominant market crowd is becoming more bullish or bearish. It is uncanny how often trend lines trace the same angle time and again in a given market. It may be because the key players seldom change. Sometimes prices accelerate away from their trend line. Then you can draw a new, steeper trend line. It shows that a trend is speeding up, becoming unsustainable. When you draw a new, steeper trend line, tighten your stop, place it immediately below the latest trend line, and adjust that stop at every new bar. The breaking of a steep trend line is usually followed by a sharp reversal. When the trend is up, volume normally expands when prices rally and shrinks when they decline. This shows that rallies attract traders while declines leave them cold. The opposite occurs in downtrends. Volume expands on declines and shrinks on rallies. A pullback on heavy volume threatens a trend line because it shows that the rebellious crowd is growing. If volume expands when prices move in the direction of a trend line, it confirms that trend line. If volume shrinks when prices pull back to a trend line, it also confirms the trend line. If volume expands when prices return to a trend line, it warns of a potential break. If volume shrinks when prices pull away from a trend line, it warns that the trend line is in danger. The breaking of a well-established trend line shows that the dominant market crowd has lost its power. You have to be careful not to anticipate trading signals. Most traders lose money when they jump the gun. A trend line is not a glass floor under the market. One crack and it is gone. It is more like a fence that bulls or bears can lean on. They can even violate it a bit without toppling it, the way animals shake a fence. A trend line break is valid only if prices close on the other side of a trend line. Some traders insist that a trend line has to be penetrated by 2 or 3 percentage points of price. After a very steep uptrend is broken, prices often rally again, retest their old high, and touch their old uptrend line from below. When that happens, you have a near-perfect shorting opportunity. A combination of a double top, a pullback to an old trend line, and perhaps a bearish divergence from technical indicators. The reverse also applies to downtrends. The neglected essentials. Volume. Volume represents the activity of traders and investors. Each unit of volume in the market reflects the action of 2 persons. One trader sells a share and another buys a share, or one buys a contract and another sells a contract. Daily volume is the number of contracts or shares traded in one day. Traders usually plot volume as a histogram, vertical bars whose height reflects each day's volume. They usually draw it underneath prices. Changes in volume show how bulls and bears react to price swings. Changes in volume provide clues as to whether trends are likely to continue or to reverse. Some traders ignore volume. They think that prices already reflect all information known to the market. They say, you get paid on price and not on volume. Professionals, on the other hand, know that analyzing volume can help them understand markets deeper and trade better. There are three ways to measure volume. 1. The actual number of shares or contracts traded. For example, the New York Stock Exchange reports volume this way. This is the most objective way of measuring volume. 2. The number of trades that took place. For example, the London Stock Exchange reports volume this way. This method is less objective because it does not distinguish between a 100-share trade and a 5,000-share trade. 3. Tick volume is the number of price changes during a selected time,
such as 10 minutes or an hour.
It is called tick volume because most changes equal 1 tick. Most futures exchanges in the United States do not report intraday volume, and day traders use tick volume as its proxy. Volume reflects the degree of financial and emotional involvement, as well as pain, of market participants. A trade begins with a financial commitment by two persons. The decision to buy or sell may be rational, but the act of buying or selling creates an emotional commitment in most people. Buyers and sellers crave to be right. They scream at the market, pray, or use lucky talismans. Volume reflects the degree of emotional involvement among traders. Each tick takes money away from losers and gives it to winners. When prices rise, longs make money and shorts lose. When prices fall, shorts gain and longs lose. Winners feel happy and elated, while losers feel depressed and angry. Whenever prices move, about half the traders are hurting. When prices rise, bears are in pain, and when prices fall, bulls suffer. The greater the increase in volume, the more pain in the market. You can lose a great deal of money in a sleepy market, such as corn, where a 1-cent move costs only $50. If corn goes against you just a few cents a day, the pain is easy to tolerate. If you hang on, those pennies can add up to thousands of dollars in losses. Sharp moves, on the other hand, make losers cut their losses in a panic. Once weak hands get shaken out, the market is ready to reverse. Trends can last for a long time on moderate volume, but can expire after a burst of volume. Who buys from a trader who sells his losing long position? It may be a short seller taking profits and covering shorts. It may be a bargain hunter who steps in because prices are too low. That bottom picker assumes the position of a loser who washed out, and he either catches the bottom or becomes the new loser. Who sells to a trader who buys to cover his losing short position? It may be a savvy investor who takes profits on his long position. It also may be a top picker who sells short because he thinks that prices are too high. He assumes the position of a loser who covered his shorts, and only the future will tell whether he is right or wrong. When shorts give up during a rally, they buy to cover and push the market higher. Prices rise, flush out even more shorts, and the rally feeds on itself. When longs give up during a decline, they sell and push the market lower. Falling prices flush out even more longs, and the decline feeds on itself. Losers who give up propel trends. A trend that moves on steady volume is likely to continue. Steady volume shows that new losers replace those who wash out. Trends need a fresh supply of losers, the way builders of the ancient pyramids needed a fresh supply of slaves. Falling volume shows that the supply of losers is running low, and a trend is ready to reverse. It happens after enough losers catch on to how wrong they are. Old losers keep bailing out, but fewer new losers come in. Falling volume gives a sign that the trend is about to reverse. A burst of extremely high volume also gives a signal that a trend is nearing its end. It shows that masses of losers are bailing out. You can probably recall holding a losing trade longer than you should have. Once the pain becomes intolerable and you get out, the trend reverses and the market goes the way you expected, but without you. This happens time and again because most amateurs react to stress similarly and bail out at about the same time. Professionals do not hang in while the market beats them up. They close out losing trades fast and reverse or wait on the sidelines, ready to re-enter. Volume usually stays low in trading ranges because there is relatively little pain. People feel comfortable with small price changes, and trendless markets seem to drag on forever. A breakout is often marked by a dramatic increase in volume because losers run for the exits. A breakout on low volume shows little emotional commitment to a new trend. It indicates that prices are likely to return into their trading range. Rising volume during a rally shows that more buyers and short sellers are pouring in. Buyers are eager to buy even if they have to pay up, and shorts are eager to sell to them. Rising volume shows that losers who leave are being replaced by a new crop of losers. When volume shrinks during a rally, it shows that bulls are becoming less eager while bears are no longer running for cover. The intelligent bears have left long ago, followed by weak bears who could not take the pain. Falling volume shows that fuel is being removed from the uptrend and it is ready to reverse. When volume dries up during a decline, it shows that bears are less eager to sell short, while bulls are no longer running for the exits. The intelligent bulls have sold long ago, and the weak bulls have been shaken out. Falling volume shows that the remaining bulls have a higher level of pain tolerance. Perhaps they have deeper pockets, or bought later in the decline, or both. Falling volume identifies an area in which a downtrend is likely to reverse. This reasoning applies to long and short time frames. As a rule of thumb, if today's volume is higher than yesterday's volume, then today's trend is likely to continue. The terms high volume and low volume are relative. What is low for IBM is high for Apple Computer, while what is low for gold is high for platinum, and so on. As a rule of thumb, high volume for any given market is at least 25% above average for the past 2 weeks, and low volume is at least 25% below average. 1. High volume confirms trends. If prices rise to a new peak and volume reaches a new high, then prices are likely to retest or exceed that peak. 2. If the market falls to a new low and the volume reaches a new high, that bottom is likely to be retested or exceeded. A climax bottom is almost always retested on low volume, offering an excellent buying opportunity. 3. If volume shrinks while a trend continues, that trend is ripe for a reversal. When a market rises to a new peak on lower volume than its previous peak, look for a shorting opportunity. This technique does not work as well at market bottoms because a decline can persist on low volume. There is a saying on Wall Street, it takes buying to put stocks up, but they can fall of their own weight. 4. Watch volume during reactions against the trend. When an uptrend is punctuated by a decline, volume often picks up in a flurry of profit-taking. When the dip continues but volume shrinks, it shows that bulls are no longer running or that selling pressure is spent. When volume dries up, it shows that the reaction is nearing an end and the uptrend is ready to resume. This identifies a good buying opportunity. Major downtrends are often punctuated by rallies which begin on heavy volume. Once weak bears have been flushed out, volume shrinks and gives a signal to sell short. Open interest. Open interest is the number of contracts held by buyers or owed by short sellers in a given market on a given day. It shows the number of existing contracts. Open interest equals either a total long or a total short position. Stock market shares are traded for as long as a company stays in business as a separate unit. Futures and options traders, on the other hand, deal in contracts for a future delivery that expire at a set time. A futures or options buyer who wants to accept delivery and a seller who wants to deliver have to wait until the first notice day. This waiting period ensures that the numbers of contracts that are long and short are always equal. In any case, very few futures and options traders plan to deliver or to accept delivery. Most traders close out their positions before the first notice day. Open interest rises or falls depending on whether new traders enter the market or old traders exit it. Open interest rises only when a new buyer and a new seller enter the market. Their trade creates a new contract. Open interest falls when a trader who is long trades with someone who is short. When both of them close out their positions, open interest falls by one contract because one contract disappears. If a new bull buys from an old bull who is getting out of his long position, open interest remains unchanged. Open interest also does not change when a new bear sells to an old bear who needs to buy because he is closing out his short position. It takes one bull and one bear to create a futures or options contract. A bull buys a contract if he is convinced that prices are going higher. A bear sells short a contract if he is convinced that prices are going lower. When the two trade, open interest rises by one contract. A single trade between one bull and one bear is unlikely to move the markets. But when thousands of traders make their trades, they propel or reverse market trends. Open interest reflects the intensity of conflict between bulls and bears. It reflects the willingness of longs to maintain long positions and the willingness of shorts to maintain short positions. When bulls and bears do not expect the market to move in their favor, they close out their positions and open interest shrinks. There are two people on opposite sides of every trade. One of them gets hurt when prices change. If prices rally, bears get hurt. If prices fall, bulls get hurt. As long as the losers hope, they hang on and open interest does not change. A rise in open interest shows that a crowd of confident bulls is facing down a crowd of equally confident bears. It points to a growing disagreement between the two camps. One group is sure to lose, but as long as potential losers keep pouring in, the trend will continue. These ideas have been clearly put forth in L.D. Belleville's classic book, Charting Commodity Market Price Behavior. Bulls and bears keep adding to their positions as long as they strongly disagree about the future course of prices. It takes conviction and disagreement to maintain a trend. Rising open interest shows that the supply of losers is growing and the current trend is likely to persist. If open interest increases during an uptrend, it shows that longs are buying while bears are shorting because they believe that the market is too high. They are likely to run for cover when the uptrend puts a squeeze on them, and their buying will propel prices higher. If open interest rises during a downtrend, it shows that shorts are aggressively selling while bottom pickers are buying. Those bargain hunters are likely to bail out when falling prices hurt them, and their selling will push prices even lower. An increase in open interest gives a green light to the existing trend. When a bull is convinced that prices are going higher and decides to buy, but a bear is afraid to sell short, that bull can buy only from another bull who bought earlier and now wants to get out. Their trade creates no new contract, and open interest stays unchanged. When open interest stays flat during a rally, it shows that the supply of losers has stopped growing. When a bear is convinced that prices are going lower, he wants to sell short. If a bull is afraid to buy from him, that bear can only sell to another bear who shorted earlier and now wants to cover and leave. Their trade creates no new contract and open interest does not change. When open interest stays flat during a decline, it shows that the supply of bottom pickers is not growing. Whenever open interest flattens out, it flashes a yellow light, a warning that the trend is aging and the best gains are probably behind. falling open interest shows that losers are bailing out while winners are taking profits. When their disagreement decreases, the trend is ripe for a reversal. Open interest falls when losers abandon hope and get out of the market without being replaced by new losers. When a bull decides to get out of his long position and a bear decides to cover his short position, the two may trade with one another. When they do, a contract disappears and open interest shrinks by one contract. Falling open interest shows that winners are cashing in and losers are giving up hope. It flashes a red light. It signals the end of a trend. Time. Most people conduct their lives as if they intend to live forever, with no review of the past, no real planning for the future, and minimal learning from past mistakes. Freud showed that the unconscious mind does not have a notion of time. Our deep-seated wishes remain largely unchanged throughout life. When people join crowds, their behavior becomes even more primitive and impulsive than when they are alone. Crowds pay no attention to time even though they are affected by its passage. Individuals are ruled by the calendar and the clock, but crowds have no notion of time. Crowds act out their emotions as if they had all the time in the world. Most traders focus only on changes in prices and pay little attention to time. This is just another sign of being caught up in mass mentality. The awareness of time is a sign of civilization. A thinking person is aware of time, while someone who is acting impulsively is not. A market analyst who pays attention to time is aware of a dimension hidden from the market crowd. Long-term price cycles are a fact of economic life. For example, the U.S. stock market tends to run in 4-year cycles. They exist because the ruling party inflates the economy going into the presidential election once every 4 years. The party that wins the election deflates the economy when voters cannot take revenge at the polls. Flooding the economy with liquidity lifts the stock market, and draining liquidity pushes it down. This is why the 2 years before a presidential election tend to be bullish, and the first 12 to 18 months following an election tend to be bearish. Major cycles in agricultural commodities are due to fundamental production factors coupled with the mass psychology of producers. For example, when livestock prices rise, farmers breed more animals. When those animals reach the market, prices fall and producers cut back. When the supply is absorbed, scarcity pushes prices up, breeders go to work again, and the bull-bear cycle repeats. This cycle is shorter in hogs than in cattle because pigs breed faster than cows. Long-term cycles can help traders identify market tides. Instead, most traders get themselves in trouble by trying to use short-term cycles for precision timing and predicting minor turning points. Price peaks and valleys on the charts often seem to follow in an orderly manner. Traders reach for a pencil and a ruler, measure distances between neighboring peaks, and project them into the future to forecast the next top. Then they measure distances between recent bottoms and extend them into the future to forecast the next low. Cycles put bread and butter on the tables of several experts who sell services forecasting highs and lows. Few of them realize that what appears like a cycle on the charts is often a figment of the imagination. If you analyze price data using a mathematically rigorous program, you will see that approximately 80% of what appears like cycles is simply market noise. A human mind needs to find order in chaos, and an illusion of order is better than no order for most people.
If you look at any river from the air, it appears to have cycles, swinging right and left. Every river meanders in its valley because water flows faster in its middle than near the shores, creating turbulences that force the river to turn. Looking for market cycles with a ruler and a pencil is like searching for water with a divining rod.
Profits from an occasional success are erased by many losses due to unsound methods. If you are serious about trading with cycles, you need a mathematical method for finding them. A farmer sows in spring, harvests in late summer, and uses the fall to get ready for winter. There is a time to sow and a time to reap, a time to bet on a warm trend, and a time to get ready for a cold spell. The concept of seasons can be applied to the financial markets. A trader can use a farmer's approach. He should look to buy in spring, sell in summer, go short in the fall, and cover in winter. Just as a farmer pays attention to the vagaries of weather, a trader needs to pay attention to the vagaries of the markets. An autumn on the farm can be interrupted by an Indian summer, and a market can stage a strong rally in autumn. A sudden freeze can hit the fields in spring, and the market can drop early in a bull move. A trader needs to use his judgment and apply several indicators and techniques to avoid getting whipsawed. The concept of indicator seasons focuses a trader's attention on the passage of time in the market. It helps you plan for the season ahead instead of jumping in response to other people's actions. Psychological indicators. Many private traders keep their market opinions to themselves, but financial journalists and market letter writers spew them forth like open fire hydrants. Some writers are very bright, but both groups as a whole have poor trading records. Financial journalists and letter writers overstay important trends and miss major turning points. When these groups become bullish or bearish, it pays to trade against them. The behavior of groups is more primitive than individual behavior. Consensus indicators, also known as contrary opinion indicators, are not as exact as trend-following indicators or oscillators. They simply draw your attention to the fact that a trend is ready to reverse. When you get that message, use technical indicators for more precise timing. As long as the market crowd remains in conflict, the trend can continue. When the crowd reaches a strong consensus, the trend is ready to reverse. When the crowd becomes highly bullish, it pays to get ready to sell. When the crowd becomes strongly bearish, it pays to get ready to buy. The reason for trading against the extremes in consensus is rooted in the structure of the futures markets. The number of contracts bought long and sold short is always equal. For example, if open interest in gold is 12,000 contracts, then 12,000 contracts are long and 12,000 contracts are short. While the number of long and short contracts is always equal, the number of individuals who hold them keeps changing. If the majority is bullish, then the minority, those who are short, has more contracts per person than the longs. If the majority is bearish, then the bullish minority has bigger positions per person. If bullish consensus equals 50%, then 50% of traders are long and 50% are short. An average trader who is long holds as many contracts as an average trader who is short. When bullish consensus reaches 80%, it shows that 80% of traders are long and 20% are short. Since the sizes of total long and total short positions are always equal, an average bear is short 4 times as many contracts as are held long by an average bull. This means that an average bear has 4 times more money than an average bull. The big money is on the short side of the market. When bullish consensus falls to 20%, it means that 20% of traders are long and 80% are short. Since the numbers of long and short contracts are always equal, an average bull holds 4 times more contracts than are held by an average bear. It shows that big money is on the long side of the market. Big money did not grow big by being stupid. Big traders tend to be more knowledgeable and successful than average. Otherwise, they stop being big traders. When big money gravitates to one side of the market, think of trading in that direction.
To interpret bullish consensus in any market, obtain at least 12 months of historical data on consensus and note the levels at which the market has turned in the past. Update these levels once every 3 months. The next time the market consensus becomes highly bullish, look for an opportunity to sell short using technical indicators. When the consensus becomes very bearish, look for a buying opportunity. Advisory opinion sometimes begins to change a week or two in advance of major trend reversals. If bullish consensus ticks down from 78 to 76, or if it rises from 25 to 27, it shows that the savviest advisors are abandoning what looks like a winning trend. This means that the trend is ready to reverse. Several government agencies and exchanges collect data on buying and selling by several groups of investors and traders. They publish summary reports of actual trades, commitments of money, as well as ego. It pays to trade with those groups that have a track record of success and bet against those with poor track records. For example, the Commodity Futures Trading Commission, CFTC, reports long and short positions of hedgers and big speculators. Hedgers, the commercial producers and consumers of commodities, are the most successful participants in the futures markets. The Securities and Exchange Commission, SEC, reports purchases and sales by corporate insiders. Officers of publicly traded companies know when to buy or sell their company shares. The New York Stock Exchange reports the number of shares bought, sold, and shorted by its members and by odd-lot traders. Members are more successful than small-time speculators. Traders must report their positions to the CFTC after they reach certain levels, called reporting levels. At the time of this writing, if you are long or short 100 contracts of corn or 300 contracts of the S&P 500 futures, the CFTC classifies you as a big speculator. Brokers send reports on positions that reach reporting levels to the CFTC. It compiles them and releases summaries once every 2 weeks. The CFTC also sets up the maximum number of contracts, called position limits, that a speculator is allowed to hold in any given market. At this time, a speculator may not be net long or short more than 2,400 contracts of corn or 500 contracts of the S&P 500 futures. These limits are set to prevent very large speculators from accumulating positions that are big enough to bully the markets. The CFTC divides all market participants into 3 groups: commercials, small speculators, and large speculators. Commercials, also known as hedgers, are firms or individuals who deal in actual commodities in the normal course of business. In theory, they trade futures to hedge business risks. For example, a bank trades interest rate futures to hedge its loan portfolio, or a food processing company trades wheat futures to offset the risks of buying grain. Hedgers post small margins and are exempt from speculative position limits. Large speculators are those traders whose positions reach reporting levels. The CFTC reports buying and selling by commercials and large speculators. To find the positions of small traders, you need to subtract the holdings of the first 2 groups from the open interest. The divisions between hedgers, big speculators, and small speculators are somewhat artificial. Smart small traders grow into big traders, dumb big traders become small traders, and many hedgers speculate. Some market participants play games that distort the CFTC reports. For example, an acquaintance who owns a brokerage firm sometimes registers his wealthy speculator clients as hedgers, claiming they trade stock index and bond futures to hedge their stock and bond positions. The commercials can legally speculate in the futures markets using inside information. Some of them are big enough to play futures markets against cash markets. For example, an oil firm may buy crude oil futures, divert several tankers, and hold them offshore in order to tighten supplies and push futures prices up.
They can take profits on long positions, go short, and deliver several tankers at once to refiners in order to push crude futures down and cover shorts. This manipulation is illegal, and most firms hotly deny that it takes place. As a group, the commercials have the best track record in the futures markets. They have inside information and are well capitalized. It pays to follow them because they are successful in the long run. The few exceptions, such as orange juice hedgers, only confirm this rule. Big speculators used to be highly successful as a group until a decade or so ago. They used to be wealthy individuals who took careful risks with their own money. Today's big traders are commodity funds. These trend-following behemoths do poorly as a group. The masses of small traders are the proverbial wrong-way Corrigans of the markets. It is not enough to know whether a certain group is short or long. Commercials are often short futures because many of them own physical commodities. Small traders are usually long, reflecting their perennial optimism. To draw valid conclusions from the CFTC reports, you need to compare current positions to their historical norms. Trading systems. The triple screen trading system. The triple screen trading system was developed by this author and has been used for trading since 1985. It was first presented to the public in April 1986 in an article in Futures magazine. Triple screen applies 3 tests or screens to every trade. Many trades that seem attractive at first are rejected by one or another screen. Those trades that pass the triple screen test have a higher degree of profitability. Triple screen combines trend-following methods and counter-trend techniques. It analyzes all potential trades in several time frames. Triple screen is more than a trading system. It is a method, a style of trading. Beginners often look for a magic bullet, a single indicator for making money. If they get lucky for a while, they feel as if they discovered the royal road to profits. When the magic dies, amateurs give back their profits with interest and go looking for another magic tool. The markets are too complex to be analyzed with a single indicator. Different indicators give contradictory signals in the same market. Trend-following indicators rise during uptrends and give buy signals, while oscillators become overbought and give sell signals. Trend-following indicators turn down in downtrends and give signals to sell short, but oscillators become oversold and give buy signals. Trend-following indicators are profitable when markets are moving, but lead to whipsaws in trading ranges. Oscillators are profitable in trading ranges, but give premature and dangerous signals when the markets begin to trend. Traders say, the trend is your friend, and let your profits run. They also say, buy low, sell high. But why sell if the trend is up? And how high is high? Some traders try to average out the votes of trend-following indicators and oscillators. It is easy to rig this vote. If you use more trend-following tools, the vote will go one way, and if you use more oscillators, it will go the other way. A trader can always find a group of indicators telling him what he wants to hear. The triple screen trading system combines trend-following indicators with oscillators. It is designed to filter out their disadvantages while preserving their strengths. Another major dilemma is that the trend can be up and down at the same time, depending on what chart you use. A daily chart may show an uptrend, while a weekly chart shows a downtrend, and vice versa. A trader needs to handle conflicting signals in different time frames. Charles Dow, the author of the venerable Dow theory, stated at the turn of the century that the stock market had 3 trends. The long-term trend lasted several years. The intermediate trend, several months. And anything shorter than that was a minor trend. Robert Rhea, the great market technician of the 1930s, compared the three market trends to a tide, a wave, and a ripple. He believed that traders should trade in the direction of the market tide and take advantage of the waves, but ignore the ripples. Times have changed, and the markets have become more volatile. Traders need a more flexible definition of time frames. The triple screen trading system is based on the observation that every time frame relates to the larger and shorter ones by approximately a factor of 5. Each trader needs to decide which time frame he wants to trade. Triple screen calls that the intermediate time frame. The long-term time frame is one order of magnitude longer. The short-term time frame is one order of magnitude shorter. For example, if you want to carry a trade for several days or weeks, then your intermediate time frame will be defined by the daily charts. Weekly charts are one order of magnitude longer, and they determine the long-term time frame. Hourly charts are one order of magnitude shorter, and they determine the short-term time frame. Day traders who hold their positions for less than an hour can use the same principle. For them, a 10-minute chart may define the intermediate time frame, an hourly chart the long-term time frame, and a 2-minute chart the short-term time frame. Triple screen demands that you examine the long-term chart first. It allows you to trade only in the direction of the tide, the trend on the long-term chart. It uses the waves that go against the tide for entering positions. For example, daily declines create buying opportunities when the weekly trend is up. Daily rallies provide shorting opportunities when the weekly trend is down. First screen, market tide. Triple screen begins by analyzing the long-term chart, one order of magnitude greater than the one you plan to trade. Most traders pay attention only to the daily charts, with everybody watching the same few months of data. If you begin by analyzing weekly charts, your perspective will be 5 times greater than that of your competitors. Trader has 3 choices: buy, sell, or stand aside. The first screen of the triple screen trading system takes away one of those choices. It acts as a censor who permits you only to buy or stand aside during major uptrends. It allows you only to sell short or stand aside during major downtrends. You have to swim with the tide or stay out of the water. Second screen, market wave. The second screen identifies the wave that goes against the tide. When the weekly trend is up, daily declines point to buying opportunities. When the weekly trend is down, daily rallies point to shorting opportunities. The second screen applies oscillators to the daily charts in order to identify deviations from the weekly trend. Oscillators give buy signals when markets decline and sell signals when markets rise. The second screen of the triple screen trading system allows you to take only those daily signals that point in the direction of the weekly trend. Third screen, intraday breakout. The first screen of the triple screen trading system identifies market tide on a weekly chart. The second screen identifies a wave that goes against that tide on a daily chart. The third screen identifies the ripples in the direction of the tide. It uses intraday price action to pinpoint entry points. The third screen does not require a chart or an indicator. It is a technique for entering the market after the first and second screens gave a signal to buy or sell short. The third screen is called a trailing buy stop technique in uptrends and a trailing sell stop technique in downtrends. When the weekly trend is up and the daily trend is down, trailing buy stops catch upside breakouts. When the weekly trend is down and the daily trend is up, trailing sell stops catch downside breakouts. When the weekly trend is up and a daily oscillator declines, it activates a trailing buy-stop technique. Place a buy order 1 tick above the high of the previous day. If prices rally, you will be stopped in long automatically when the rally takes out the previous day's high. If prices continue to decline, your buy stop will not be touched. Lower your buy order the next day to the level 1 tick above the latest price bar. Keep lowering your buy stop each day until stopped in, or until the weekly indicator reverses and cancels its buy signal. When the weekly trend is down, wait for a rally in a daily oscillator to activate a trailing sell-stop technique. Place an order to sell short 1 tick below the latest bar's low. As soon as the market turns down, you will be stopped in on the short side. If the rally continues, keep raising your sell order daily. The aim of a trailing sell-stop technique is to catch an intraday downside breakout from a daily uptrend in the direction of a weekly downtrend. Proper money management is essential for successful trading. A disciplined trader cuts his losses short and outperforms a loser who keeps hanging on and hoping. The triple screen trading system calls for placing very tight stops. As soon as you buy, place a stop-loss order 1 tick below the low of the trade day or the previous day, whichever is lower. Once you sell short, place a protective stop-loss 1 tick above the high of the trade day or the previous day, whichever is higher. Move your stop to a break-even level as soon as the market moves in your favor. Afterwards, the rule of thumb is to move your stop to protect approximately 50% of paper profits. The reason for using such tight stops is that triple screen trades only in the direction of the tide. If a trade does not work out fast, it is a sign that something is fundamentally changing below the surface of the market. Then it is better to run fast. The first loss is the best loss. It allows you to re-examine the market from the safety of the sidelines. Conservative traders should go long or short on the first signal of the triple screen trading system and stay with that position until the major trend reverses or until stopped out. Active traders can use each new signal from the daily oscillator for pyramiding the original position. A position trader should try and stay with a trade until the weekly trend reverses. A short-term trader may take profits using signals from the second screen. For example, if a trader is long and force index becomes positive or stochastic rises to 70%, he may sell and take profits, then look for another buying opportunity. The triple screen trading system combines different time frames and several types of indicators. It uses a trend-following indicator with the long-term charts and a short-term oscillator with the intermediate charts. It uses special entry techniques for buying or selling short. It also uses tight money management rules. Channel trading systems. Prices often flow in channels, the way rivers flow in valleys. When a river touches the right edge of its valley, it turns left. When a river touches the left rim of its valley, it turns right. When prices rally, they often seem to stop at an invisible ceiling. When they fall, they often seem to hit an invisible floor. Channels help traders identify buying and selling opportunities and avoid bad trades. Channels parallel to trend lines are useful for long-term analysis, especially on the weekly charts. Channels around moving averages are useful for short-term analysis, especially on daily and intraday charts. Channels whose width depends on volatility are good for catching early stages of major new trends. Support is where buyers buy with greater intensity than sellers sell. Resistance is where sellers sell with greater intensity than buyers buy. Channels show where to expect support and resistance in the future. A channel's slope identifies a market's trend. When a channel lies flat, you may trade all swings within its walls. When a channel rises, it pays to trade only from the long side, buying at the lower wall and selling at the upper wall. When a channel declines, it pays to trade only from the short side, shorting at the upper channel wall and covering at the lower wall. When prices rise above the average consensus of value, sellers see an opportunity to take profits on long positions or go short. When they overpower the bulls, prices decline. When prices fall below the moving average, bargain hunters step in. Their buying and short covering by bears lift prices, and the cycle repeats. When prices are near their moving average, the market is fairly valued. When prices are at or below the lower channel line, the market is undervalued. When prices are at or above the upper channel line, the market is overvalued. Channels help traders find buying opportunities when the market is cheap and shorting opportunities when the market is dear. The market is like a manic depressive person. When he reaches the height of mania, he is ready to calm down, and when he reaches the bottom of his depression, his mood is ready to improve. A channel marks the limits of mass optimism and pessimism. Its upper line shows where bulls run out of steam, and its lower line shows where bears become exhausted. Every animal fights harder closer to home. The upper channel line shows where bears have their backs against the wall and fight off the bulls. The lower channel line shows where bulls have their backs against the wall and fight off the bears. When a rally fails to reach the upper channel line, it is a bearish sign. It shows that bulls are becoming weaker. If a rally shoots out of a channel and prices close above it, it shows that the uptrend is strong. The reverse rules apply in downtrends. Channels help traders who use them remain objective when others get swept up in bullish or bearish hysteria. If prices touch the upper channel line, you see that mass bullishness is being overdone, and it is time to think about selling. When everyone turns bearish, but prices touch the lower channel line, you know that it is time to think about buying instead of selling. Amateurs and market professionals handle channels differently. Amateurs bet on long shots. They tend to buy upside breakouts and sell short downside breakouts. When an amateur sees a breakout from a channel, he hopes that a major new trend is about to begin and make him rich quick. Professionals trade against deviations and for a return to normalcy. It is normal for prices to remain within channels. Most breakouts are exhaustion moves that are quickly aborted. Professionals like to fade them, trade against them. They sell short as soon as an upside breakout stalls and buy when a downside breakout stops reaching new lows. Breakouts can produce spectacular gains for amateurs when a major new trend blows out of a channel. Amateurs occasionally win, but it pays to trade with the professionals. Most breakouts are false and are followed by reversals. Risk management. Trading is so exciting that it often makes amateurs feel high. A trade for them is like a ticket to a movie or a professional ball game. Trading is a much more expensive entertainment than the cinema. Nobody can get high and make money at the same time. Emotional trading is the enemy of success. Greed and fear are bound to destroy a trader. You need to use your intellect instead of trading on gut feeling. A trader who gets giddy from profits is like a lawyer who starts counting cash in the middle of a trial. A trader who gets upset at losses is like a surgeon who faints at the sight of blood. A real professional does not get too excited about wins or losses. The goal of a successful professional in any field is to reach his personal best, to become the best doctor, the best lawyer, or the best trader. Money flows to them almost as an afterthought. You need to concentrate on trading right and not on the money. Each trade has to be handled like a surgical procedure, seriously, soberly, without sloppiness or shortcuts. Emotional traders want certain gains and turn down profitable wagers that involve uncertainty. They go into risky gambles to avoid taking certain losses. It is human nature to take profits quickly and postpone taking losses. Irrational behavior increases when people feel under pressure. Emotional trading destroys losers. If you review your trading records, you will see that the real damage to your account was done by a few large losses or by long strings of losses while trying to trade your way out of a hole. Good money management would have kept you out of the hole in the first place. You can win only if you trade with a positive mathematical expectation, a sensible trading system. Trading on hunches leads to disasters. Many traders act like drunks wandering through a casino, going from game to game. Slippage and commissions destroy those who overtrade. The best trading systems are crude and robust. They are made of a few elements. The more complex the systems, the more elements that can break. Traders love to optimize their systems using past data. The trouble is, your broker won't let you trade the past. Markets change, and the ideal parameters from the past may be no good today. Try to de-optimize your system instead. Check how it would have performed under bad conditions. A robust system holds up well when markets change. It is likely to beat a heavily optimized system in real-world trading. Finally, when you develop a good system, don't mess with it. Design another one if you like to tinker. As Robert Prechter put it, most traders take a good system and destroy it by trying to make it into a perfect system.
Once you have your trading system, it is time to set the rules for money management.
Suppose you and I bet a penny on a coin flip. Tails you win, heads you lose. Suppose you have $10 of risk capital and I have $1. Even though I have less money, I have little to fear. It would take a string of 100 losses to wipe me out. We can play for a long time, unless two brokers get between us and drain our capital by commissions and slippage. The odds will dramatically change if you and I raise our bet to a quarter. If I have only $1, then a string of only 4 losses will destroy me. If you have $10, you can afford to lose a quarter 40 times in a row. A series of 4 losses is likely to come much sooner than 40. All other factors being equal, the poorer of 2 traders is the first to go broke. Most amateurs think that other factors are far from equal. They consider themselves brighter than the rest of us. The trading industry works hard to reinforce that delusion, telling traders that winners get the money lost by losers. They try to hide the fact that trading is a minus-sum game. Cocky amateurs take wild risks, producing commissions for brokers and profits for floor traders. When they blow themselves out of the market, new suckers come in because hope springs eternal. Institutional traders as a group tend to be more successful than private traders. They owe it to their bosses, who enforce discipline. If a trader loses more than his limit on a single trade, he is fired for insubordination. If he loses his monthly limit, his trading privileges are suspended for the rest of the month and he becomes a gopher, fetching other traders coffee. If he loses his monthly limit several times in a row, the company either fires or transfers him. This system makes institutional traders avoid losses. Private traders have to be their own enforcers. An amateur who opens a $20,000 trading account and expects to run it into $1 million in 2 years is like a teenager who runs away to Hollywood to become a pop singer. He may succeed,
but the exceptions only confirm the rule.
Amateurs like to get rich quick, but destroy themselves by taking wild risks. They may succeed for a while, but hang themselves, given enough rope. Amateurs often ask me what percentage profit they can make annually from trading. The answer depends on their skills or lack of such and market conditions. Amateurs never ask a more important question. How much will I lose before I stop trading and reevaluate myself, my system, and the markets? If you focus on handling losses, profits will take care of themselves. A person who makes 25% profit annually is a king of Wall Street. Many top-flight money managers would give away their firstborn child to be able to top this. A trader who can double his money in a year is a star, as rare as a pop musician or a top athlete. If you set modest goals for yourself and achieve them, you can go very far. If you can make 30% annually, people will beg you to manage their money. If you manage $10 million, not an outlandish amount in today's markets, your management fee alone can run 6% of that, or $600,000 a year. If you make a 30% profit, you will keep 15% of it as an incentive fee, another $450,000. You will earn over $1 million a year trading without taking big risks. Keep these numbers in mind when you plan your next trade. Trade to establish the best track record with steady gains and small drawdowns. Most traders get killed by one of two bullets: ignorance or emotion. Amateurs act on hunches and stumble into trades that they should never take due to negative mathematical expectations. Those who survive the stage of virginal ignorance go on to design better systems. When they become more confident, they lift their heads out of the foxholes, and the second bullet hits them. Confidence makes them greedy. They risk too much money on a trade, and a short string of losses blows them out of the market. If you bet a quarter of your account on each trade, your ruin is guaranteed. You will be wiped out by a very short losing streak, which happens even with excellent trading systems. Even if you bet a tenth of your account on a trade, you will not survive much longer. A professional cannot afford to lose more than a tiny percentage of his equity on a single trade. An amateur has the same attitude toward trading as an alcoholic has toward
I
drinking.
didn't know that I was
He sets out to
here
have a good
live.
time.
Definitely had to get in touch today. That's just a fail. All right, we'll get back to that. We got most of the book. I'll double tap on that last chapter there here shortly. Awesome team over at Top Step. Just got off the phone with billing and risk management. Could have just been billing. I don't know. I appreciate you. I appreciate you. So, I got 6 accounts, 3 in a tremendous drawdown, 3 fresh. Let's go take 5 of these to XFA. So what I'm gonna do is did my morning yoga already, my stretching, my meditating. I'm gonna reset now. I'll be back for the open. We're definitely off into this pre-market. It's starting to give me some signs getting moving. I'm gonna pay attention to this trade today. Some other trades that I'm gonna be taking a look at, just back testing. Think we're off in the ES today. Maybe some gold. It's just, you see what it is. I'm just gonna see if this is gonna Bart Simpson on me. This is not a bad trade here. I got some room to do it with. We're gonna lock in on this trade here. I know this trade, and then we're gonna also have NQ up. So what I'm gonna do is we're gonna go ahead and shut this one down. And from there, you're gonna catch me bell to bell. I'll be here shortly before or shortly after the US Open. And we're gonna do it all over again. Alright. This is what I do and how I do it. And the biggest contradiction is it ain't none of your business. Y'all be cool. See you soon. Mike, check